थोडासा फरक आहे, ते जाऊ दे, मी करतो ते बरोबर. डोंट वरी. पीपीटी मी दुसरी पाठवू शकलो असतो, पण राहू दे. तुमच्याकडे 5 मिनिटं असली तर पाठवतो.
सर हीच पीपीटी आहे ना आजची?
नाही, तुम्हाला दुसरी थोडीशी वेगळी आहे, पण ते चालतंय, तेवढं करू ऍडजस्ट. माझ्याकडे आहेत दोन्ही, मी बोलतोय ते पण आहे आणि तुम्हाला पाठवलेलं पण आहे. काय नाही प्रॉब्लेम, जाऊ दे पुढे.
ओके सर, ओके सर,
आपण करूया त्याच्यावर.
स्टार्ट करायचं सर?
तुम्ही सांगा किती लोक आले. कमी पार्टिसिपंट आहेत, तुम्हाला थांबायचं असेल तर थांबा. हे आले का आपले दुसरे स्पीकर कुठे आहेत?
सर ते बहुतेक 5:30 ला जॉईन करणार आहे सांजगिरे सर.
हा, पण त्यांच्याशी बोलणं झालं का? ते दुपारी मला त्यांनी फोन केला की फोनच नाही आला कोणाचा.
सर झालं बोलणं त्यांच्याशी.
झालंय ना? हा, मग ठीक आहे सर. तू विचार कर किती जॉईन झाल्यानंतर जॉईन करायचं, त्याप्रमाणे करतो. स्टार्ट करायचं. आता 22 लोक दिसत आहेत मला, आपण सगळे धरून. तू म्हणत असशील तर चालू करूया.
सर इंट्रोडक्शन पार्ट कव्हर करून घेऊ वाटलं.
हा, चल चालू कर जस्ट स्टार्ट. ओके. DEEP4
So good evening to all the members. I welcome you all for the webinar on auditing standards. Once again, we have with us our beloved Central Council member Srinivas Joshi sir with us. Yesterday we had sir has covered SA 700, 705 and 706. Sir is going to cover today SA 550, 560 and 570. So before starting with this session, let me introduce our today's speaker. Sir is a partner in CVK and Associates. He is practicing chartered accountant since 40 years. Special interest in subjects like accounts, auditing, company law, and FEMA. Sir is an elected council member of Institute of Chartered Accountants of India for the period 13 to 16 and 19 to 22. Sir was chairman of WRC of ICI for the year 2011-12 and secretary for the year 2005 and 2006. Sir was regional council member for the year 2004-2007, 2007-2010, and 2010-2013. Sir was also convener of Mulund Study Circle for the year 2000-2002. Currently, Sir is chairman of Financial Reporting Review Board for the year 1920, chairman of PDC Committee 2021, vice chairman of Audit Committee, Union Directorate, Audit and Assurance Standard Board, Coordination Group for Members and Student Services, Banking, Insurance and Pension, IFRS Committee, Internal Audit Standard Board, Expert Advisory. Sir was member of several important committees of ICS such as Examination Committee, Executive Committee, Management Committee, Finance Committee, Auditing and Assurance Standard Board, Internal Audit Standard Board, Accounting Standard Board, Expert Advisory Committee, Board of Studies, Commercial Laws and Economic Advisory. Sir was speaker at various seminars of chartered accountants and students at WRC and its branches on subjects like accounting standard, auditing standard, company law, bank audit, FEMA, networking and merger, peer review, career counseling on how to face CA exam for past 16 years. Sir is director at independent director at L&T Mutual Funds Trustee Limited, director on XBRL Limited, director on Accounting Research Foundation IC. Sir was president of Rotary Club of Mumbai Mulund East for the year 2012-13. With this brief introduction, I request our Central Council member Srinivas Joshi sir to address this gathering on these auditing standards SA 550, 560 and 570. Over to you, sir.
Good afternoon to all the listeners, and thank you, Secretary Ji, for a nice introduction, Sohel Ji. Friends, yesterday we spoke on a 700 series, which was very important to us from reporting requirements. Of course, when we talked on those series, there were several references to other items, which we refer in our audit reports, and we need to consider them in more detailed manner. That's why we have selected some of some of the standards, which are more relevant to us from that perspective. So I think we will start this particular session with SA 570 because that is very relevant to us as far as the going concern basis of accounting is concerned. Next slide. Sohel, next slide. So this is a going concern SA 570 standard on auditing, as we talked yesterday. That standard on auditing 570 is on going concern. Next slide. Sohel, next slide. तोपर्यंत तुम्ही ह्यातल्या 560 आणि 550 हे पाठवत आहे ना, बाहेर काढायला लागेल तेवढं. Hello. Yeah. So considering the going concern basis of accounting, all of you are aware that there are few fundamental accounting assumptions on which we prepare our accounts. For example, accrual is one of them, and when it is a cash basis, we will like to comment. We will like to comment that it is a cash basis, and because cash basis cannot give appropriate, true and fair view, and therefore this is where you need to, Madam Bhai, where you need to write if it is this type of fundamental assumption is violated. There are three fundamental assumptions: accrual system of accounting, going concern, and consistency. Means consistency in applicability of various accounting policies year after year. And when this is violated, we would be very much concerned about the difference in the profits, a difference in the asset or liabilities that would occur. And therefore, we are very cautious about it as auditors. So here, when this fundamental accounting assumption is being considered, whether it is properly considered or not. Yesterday we talked of SS 700, where the format of the report now requires auditor to say that this is a going concern, and also we write in management responsibility paragraph, it is their responsibility also to say that it is a going concern. So when both the parties to the accounts or the financial statements are saying that we need to say or talk about going concern and how this basic assumption in accounting is properly taken care of, then I think it is more important for us to understand that. Now the continuance of the operation in the foreseeable future is considered as necessary to say that a concern is a going concern. What is a foreseeable future? Because future can be taken as 1 day to 1 year to 100 years. So we will see what is a foreseeable future. But if you want to say that which events or conditions may be required to be considered by all of us to think that a particular organization is a going concern or not, is given in SA 570 para A3. This para says that the examples of events or conditions that individually or collectively may cast a significant doubt on the entity's ability as a going concern. So these events and conditions individually or collectively to be considered are listed in para A3. I'm not saying talking about all of them, but some of them which are very, very prominent are that when the net liability position is negative, that is current asset minus current liability, current assets have to be more than current liabilities. Now here, the first thing that you can consider for taking into consideration the going concern concept is whether the current liabilities exceed the current asset. That means immediate future of an organization is in great trouble unless you can prove that the finances are available. The second event or second condition that we can check is whether there is a fixed term maturity borrowing, that is, a term loans are about to mature in this period, in the coming say 12 months, and whether there is a realistic prospects of either those loans would be renewed or they may be repaid, and from where you are going to repay. So if the fixed term borrowings are approaching maturity, whether the organization is in a position to service them or renew them in the normal course of business is the second thing I like to consider when I'm looking at going concern concept. Coming to the other one, that you should see that whether there is a support of the creditors or the lenders is there or it is being withdrawn. For example, in case of Jet Airways, you will find that auditors resigned because they found that support was, for example, SBI was giving a support. They were lead bankers to Jet, and they say we will not invest more money, and they are requested Jet to get the investor. So here, that is another indication that the organization may not be a going concern. And when auditors resigned on this point, it was proved to be right that Jet was not a going concern in few months itself. Now, coming to the other indicators which are very, very prominent is the negative cash flows. Now, negative cash flows means the cash in hand, that is the cash plus bank, what we call cash in hand. Cash and bank balances are reducing continuously. So you are having a negative operating cash flows, remember, and that is being financed by other means. So a negative cash flows, operating cash flows also year after year indicate this. Now, considering that another indicator is substantial losses in the accounts over the year, which is year after year, you'll find that there are losses by the organization. Another one is the falling sales and revenues. So you will find that suppose company was having a sale of 10 crore, now it is 8 crore, then 5 crore, then 3 crore, continuous reduction in sale value, and therefore the fixed cost is resulting into the losses. Now, substantial operating losses, substantial negative cash flow, and substantially negative net worth position are three very, very basic things to be seen, other than the current liabilities exceeding the current asset and fixed term borrowing reaching the limits. These are, of course, financial indicators. There are several operational indicators, operating indicators given in that para, and some of them are given as the loss of key management personnel without replacement. Now, when you have such kind of indication that there is suppose MD has left, some of the independent directors resigned, or some of the key person like sales head, the factory head resigned, and there is no replacement. They are just promoting the juniors just to run the show. So this is one indicator, an operating indicator where the company or the organization may be in great trouble. Now, loss of major market or loss of key customers or licenses or loss of key suppliers also indicate that there is some great trouble ahead of this particular organization. Apart from other things, of course, emergence of highly successful competitor is also an indicator. I'm not saying that is the only indicator. Again, I'm saying, for example, the Hindustan Lever and other FMCG companies were challenged by the Indian producer of the Ayurvedic medicines. Now, if that is challenged, in that case, that is also one of the indicators that is a very strong presence, and then they have taken some very large market share from a company A. For example, Ramdev Baba created an Indian brand, and then Patanjali brand, which was created a huge problem for FMCG in the initial years. Now, this kind of thing, which if happens for a smaller company, it would get wiped out. So this is where you have an operating indicator. There are other indicators also. For example, in other indicators, non-compliance with statutory or regulatory requirements relating to solvency or liquidity ratios are required. For example, the banks, the insurance companies, they need, or NBFCs, they need solvency liquidity requirements. And if they are not satisfied, that is one of the condition, like, the stress test that is done by RBI for banks indicate that these ratios would not be maintained. In that case, those banks are merged with other banks because they are not likely to survive for a long. Another indicator may be pending legal or regulatory proceedings against the entity that if successful, will wipe out the entity or will create a huge problem for the entity. So when such a regulatory proceedings are pending, and which if you need to see whether as an auditor you agree to the appeal made, or you feel appeal is frivolous, and in any case they're likely to lose, or they have decided cases against them and there are very less chance. In that case, it's an indicator that if they lose in the near future, it will be wiped out. The organization will be wiped out. Of course, there are many other indicators. I'll not go for it. I will go for mitigation of this as the time comes. As to this is, of course, the indicators. Now we need to also see whether the management itself thinks of liquidation. If the management says we are going to liquidate the entity or cease our operations, or whether they say it or not, they have no alternative but to do so. Means they have no alternative considering the current financial situation. They will have to close, whether there is an intention to liquidate or cease operation. Either of this case, the going concern concept will be challenged. Now then, whenever this is challenged, we have to see that use of going concern basis of accounting is appropriate. Assets and liabilities are, when it is appropriate, assets and liabilities are recorded on the basis that the entity will be able to realize the assets and discharge liabilities in the normal course of business. This is the note many of us give to the accounts, saying that the directors confirm that in the normal course of business, the assets will be realized and they will be able to discharge the liabilities. Next. One of the things that you should know is that the standard protects us from this issue of going concern by saying that if the auditor has not given any reference of material uncertainty about going concern, in a sense he has tested it and it feels that there is nothing required to be mentioned, does not by itself indicates, and there is no guarantee that entity will continue as a going concern. So they say that this depends on the situation at the time of which audit is done, the time at which the management has taken the view that it is a going concern, and therefore even if there is no comment by the auditor itself on this, there is nothing to say that means if the auditor has not commented, it is a going concern. So there is no guarantee. And obviously there cannot be any guarantee saying that this is required. Now, this particular going concern assumption actually is relevant even for income tax audit, etc. But the financial statement may not be prepared for that particular thing in mind, is what the standard is saying. Next. Now here, friends, we need to see about this fundamental assumption that preparation of financial statement, they have to, the management, it is a management responsibility to prepare a statement based on either the organization as a going concern or organization not as a going concern. Now, when the management is trying to assess this particular situation from this particular angle, that whether it is a going concern or not, what management will consider? Management will consider the several things, but the uncertainty associated with the outcome of the events or condition will increase substantially as the period for which this assessment is done is extended. Now, normally the period is 12 months from the date of financial statement for which this assessment is made. But recently, after pandemic like COVID, some of the countries have said that this period should be 36 months. So you consider whether the organization is a going concern over 36 months. Because today, if you look at sales, profits, then you can never say in next 12 months this organization will survive. Though countries like Italy have said that this should be 36 months, but the standards whatever had still not been changed. But because these standard itself says that the degree of uncertainty here will increase as the period increases about the events or the outcome of the events or the outcome of the conditions. I am assuming today that this will happen or not happen, that may substantially change. Another thing that can be a problem to the management is the size and complexity of the entity itself. Means the larger the size, the bigger is the problem. Complex is the entity. Suppose there are huge web of subsidiaries or joint ventures and all, then it's very difficult to judge what will happen to the company. And nature and condition of business, the nature of business which you are in may create a doubt. For example, if you are in information technology industry, then you can have suddenly something coming up in information technology will wipe out the old thing. For example, you are doing the computers, the older computers were replaced by smaller chips. So computers or it came to laptops, then now it is iPads, and then there are readable on the instrument on which you can read. Now there are many developments. Even in the watch you can have the TV scene. Now these kind of developments, it depends on the nature of business. This going concern, suddenly you can have a competition which will wipe you out. For example, if you see the automobile industry, the electric cars, which is the future of this world, may wipe out a diesel car or a petrol car. And diesel and petrol in any case would be in short supply. After 25 years, it will be over in the world. So in any case, you need an alternative. So suppose a solar car is developed. Now these kind of developments about the nature of business if they are considered, would have a problem about the going concern. About the conditions of business, the business is at its peak in the cycle, then it is started going down. Though whether the downward cycle they will survive and still come up in the next cycle or not can be a serious issue. These issues come up in shipping industry. Shipping industry has a big cyclical wave, and in a cyclical wave, the best of the best companies would keep on adding to the tonnage. They call it tonnage when they buy the ships. They keep on adding to the tonnage, and in the peak period when everybody wants to run the ships and have a lot of business, they will sell off the tonnage. And there is one listed company, you are aware of it, GE Shipping. They make more profit from buying and selling tonnage than the goods that they transport at one point of time. So this is where you can have money, and you can use the money in the best possible manner, because when the prices are lowest for ships, they will buy when it is in through, and when at peak, they will keep on selling the tonnage to others. They would buy and try to do the business or rent it out to them. So this is where, the condition of business where it is currently may decide whether it is a going concern in that. And this we have to see that all the judgment in this is being made by the management, which is on basis of information available at the time at which the judgment is made. Because if you are, and therefore it is possible that this judgment can go wrong or maybe proved to be wrong but the way the judgment was made was reasonable at the time the judgment was made. So we have to see that this judgment was right at the point it was taken. As an auditor also, I am responsible to see that. But one thing you should always say, that suppose 12 months is taken as a period for review. If it is beyond 12 months, means in a sense that they do only 6 months review, suppose, and you want a 12-month review, or if they do 12-month review and you feel that you need a 36 months review, you should always inquire with the management as to its knowledge on events and conditions beyond the period of management's assessment. So here we should know that as an auditor, we should ask for this period of review. Next slide. Now here, I already told you this particular, repayment. Next slide. The next slide. This also I talked about. Law, regulation, government policy, adversely impeding illegal. Next slide. Now let us see what is this. Now we talked all of the various things on which the going concern concept is tested. Now, once it is tested, you come to a conclusion that there is very, very serious issue about this company, which can be called a going concern. By just operating profit, this will never survive. By just, if you see the falling sales, if you see the various other things, what I discussed, you will feel that no, they just don't have money. There is a credit, the current liabilities are exceeding current asset for several years now, from where they are going to pay, and all sorts of things are there. But there can be mitigating factors. The mitigating factors can be disposing of assets. That is one way. So it is always, the banks would advise the organization to dispose the non-core asset, what they call non-core asset. For example, if you are a company in a particular industry, suppose you are a steel company and you have bought something else which is unrelated to your business as a subsidiary, they will say you hive off a subsidiary. First, you hive off a business in subsidiary, and then subsidiary can be sold off because this is not your way of running. I'll give you a practical example of this, that the companies doing manufacturing biscuits started making chocolates, and those wearing chocolates started manufacturing biscuits, and both of them competed with each other for biscuits with chocolate. Now, with that, they wanted to expand in ice cream. They both these type of companies, and the companies which is nothing but Cadbury's, or companies which were like Britannia, which were in biscuit, and Cadbury was in chocolate, and they tried to manufacture each other's product, but both of them tried to go in ice cream business. Now, when they tried to go in ice cream business, they failed miserably. And ice cream business is done in a particular way which these companies had no idea how it is done. And therefore, they had to hive it off. They sold off these divisions which were substantially loss making. I'm not saying these companies were ever threatened with going concern concept by itself, but I'm saying how the assets are disposed of. Assets which are non-core, these were non-core assets to their core business. And suppose ITC as a company buys some plant for making, having the bottled water. No, that is not a core business of ITC. So ITC can hive it off, sell it off. So similarly, in any company which is in difficulty, first we'll say, what is my core strength? And other than core strength, the assets may be disposed of. So some of the divisions may be sold, some of the subsidiaries may be sold, some of the joint venture you are withdrawing and selling that part to some other person who is interested. Like that. So this is disposing of asset. Second, and then get that cash, introduce that cash, and all losses you made, and therefore your current assets were less than your current liabilities, get more bank balance and pay off your liabilities. So this is one way of mitigating factors, saying that yes, at least I have the ratios now set right. Restructuring of debts. Now, the problem I told you, that one of the consideration is that the fixed maturities, fixed period term loans, which are coming for maturity, we are unable to repay or renew. Now, in such cases, you should renew them as restructured debt. So what happens is our liability to repay would be lesser and lesser. In the initial period is less. So you are able to repay. So you can show the auditors, for example, if you are in company management, you can show to auditors, and now the reduced burden of repayment I can repay, which was say double. Suppose I had to repay 5 crore, now I pay only 2 crore in the restructured debt. Now it is possible that I can repay that. So then my going concern is not affected. So restructuring of debts if possible. Rescheduling of loans, loan repayments, reduced or delayed expenditure. Now here, friends, there is a huge expenditure in many cases about repairs and maintenance. Many times this overhauling of plant is required in chemical industry, in sugar industry, in several industries. There is a cycle of the repairs or the major repairs that they call, or the overhauling of plants. Now that is delayed. Sometimes it is delayed, or it is reduced, in a sense the expenditure is reduced by replacing those parts which are very critical and may not survive. Otherwise, parts are not replaced, and therefore expenditure is put as less. You can of course borrow new money if somebody is ready to give, even at higher rate of interest, because borrowing money would immediately set pressure off on various things as far as your balance sheet is concerned. And therefore borrowing new money, you can borrow money means you can even think of private investors if they are agreeing to give you money. Not necessarily, you can borrow money of course from the owners also. So we can borrow money from our own holding company, we can borrow from directors, current shareholders, etc., because they are interested in running this company in future. We can also think as a mitigating factor that obtaining additional capital. Now, obtaining additional capital is obviously possible through our owners, where we can take the capital as a preference share capital, for example. So it doesn't keep any pressure either of dividend immediately or of interest like borrowed capital. So you can have the various things like that mitigating factors. Of course, finalizing alternative supplies is also a way of saying that whether it is that we can have a mitigating factor. Next slide. Yeah. Now the responsibility of the auditor. It is said about, we are talking now the responsibility of the auditor, and then we have evaluating the management responses. Now, when responsibility of the auditor we are looking at, we are saying that we should obtain sufficient appropriate audit evidence regarding the conclusion based on management. Now we will discuss this little later also, where material uncertainty exists about ability to continue and the adequate disclosure is made in the notes to account, etc., then we are satisfied that there will be a going concern. Maybe there is a doubt. There are significant doubt on ability to continue. So I have gone into management plans. I explained some of the management plans to you in the previous slide. I will look at these plans and then decide that they are feasible. Something is happening positively relating to these plans, and therefore, and it is possible that, for example, the banks have given some letter, yes, we are in negotiation, we are interested in giving loan, or directors say that, yes, we commit that so much finance will give, or you have already gone to market to give at least raise preference capital which is available to you, or private lenders have agreed to something in writing. So you are saying it is not only feasible, it is on the right track, and therefore, even though there can be a problem currently, that there are events or condition, it casts significant doubt on entity's ability to continue as a going concern. They are properly disclosed by the management, and management, maybe it looks like in trouble, but they have right path on which they are, and they will come out of it very soon. So that is how you can think of it. Next slide. Now here, what we are evaluating in the management, when management is saying, yes, everything will be all right. I told you that whether the plans are likely to improve the situation. So all that, suppose assuming I say, yes, I will get new loan. Yes, it will be rescheduled. Yes, I will get a preference capital. I must first say, and then I know the values. They will raise 2 crore by one possibility, 2 crore by another method. They will sell off asset which will give them 1 crore. Now, all that possibility together, I will get, say, 5 crores. Now, I need 25 crores. Now, this outcome of the plan is to give me 5 crores is not sufficient to make it a going concern. I feel that minimum we need 25 crores to survive. In that case, outcome of the plans should be likely to improve the situation in future. So at least I have 15 crores by all these methods. I may survive for a little longer, if not 25 crores. But if there is no improvement in situation possible with just 2 crore, for example, management says this is what proof I am giving, I am getting 2 crore immediately. That may not, the company may not survive at all, or the organization may not survive at all. So in that case, it should not be that only I look at the plans, not only I look at whether the plans are feasible, I not only look at there are confirmations that these plans can be actually implemented. After all plans are implemented, whether situation will improve or not is also to be considered. It is not that I just give you a proof of 1 crore where 25 crores are required and there is a confirmed credit is about to come in next 10 days or 15 days, and then I say it is a going concern. It is not. Second is, there are cash flow forecasts. Cash flow forecast, whenever they are made, saying that yes, in future our sale is going to increase, our cash flow is going to increase from debtors from, say, foreign country, or debtors which were so far not realized more than 3 years or for a longer time, or 1 year, 2 years, they have decided to pay. We have settled with them. about the credit notes we are given, now balance money will come. So I am saying that my cash flow forecasts are based on various underlying data and underlying assumptions. Now when that underlying data, first of all, the data comes from the past. Now that data and the assumptions that I will recover from debtors, I will settle with my creditors at 50%. Now these kind of assumptions, and say that accordingly I write my cash flows for future, and say all cash flows are positive, and in future I'll be able to repay my debts, etc. This needs to be properly analyzed. Now, another thing to be analyzed is suppose term loan agreements. Now, we need to have the various financial arrangements to be checked, that whether they are really in place, and this is possible that I actually get money out of it. Now, uh, when we have a very highly profitable operations itself, we do not, that itself, suppose I have been in profit for years and I have a cash profit also for years, and I have been getting ready finance from various organizations just for asking. For example, highly profitable companies would get ready finance anytime from even bankers, financial institutions, or even private investors. When there is a history like this kind of evaluation is not required at all. What I told you, that you have the cash flows forecast and I think, because the history shows that are extremely steady organization, and only the facts, that additional facts or information you can take a written representation from the management and say that yes, in that case I am assuming that everything is going to be good or everything is going to be right. I need not make a detailed study of what is being stated. Now coming to this particular assessment of the management assessment, we can see some of the other things, like we can see the latest available interim financial reports. We can see the minutes of the shareholders of the meeting, etc. We can see the existence of litigation and claims, and whether some of the claims are likely to be received, our litigation with others. We can have the legality and enforcement of agreement for financial support. We can check the procedure regarding subsequent, so we can see some of the subsequent events from the balance sheet date for mitigating factors, and various things we can see in this particular situation. Now coming to the next one, go to next. Before we go to the, we can talk about the smaller entities here. We can also just consideration specific to smaller entities, and then we have the auditor's report. Yes. So when the entity is small, like most of us are dealing with very small entities, and therefore we need to look at this as to how the small entities will cope up with this. Now, the smaller and smaller is the entity, less is the chance that it will survive. For example, in this pandemic relating to this particular COVID, most of the SSI unit or MSME units were in very serious trouble. If you really see the way it is done, way it is seen, they are the one which are closed down. Not only that, some of them say that we can never probably function again. So the size of the entity affects its ability to withstand the adverse condition. Now their workers have left for UP or Bihar from Maharashtra, and they are not ready to come back in this condition. You are not getting the labor at that rate, and you're not getting a skilled labor. Now this smaller is the size, more are the problems, and more is the problem of survival as a going concern. Now, but there are benefits also. They may quickly exploit the opportunities, but may lack reserve to sustain the operation. Now, what is the problem here? In COVID situation, you wanted the various types of things to be used during COVID. For example, mask, for example, chemicals. Now, this particular one, the smaller entities were quick to start manufacturing of that and start selling that. So they change their position, their market position, and they have taken benefit of the market condition to quickly change. But they lack money. For example, the goods are selling fast and recovery is there, then they can survive. But if the goods are being sold and recoveries are late, For whatever reason, the shopkeepers are not ready to pay because they themselves are in trouble having their own fixed expenses to be covered. In that case, they are not paying us, even though the goods are selling on the counter. So in that case, they have lack reserves. So small entity may say that they have shifted their focus from the product A to product B in this condition. Pandemic, of course, is one of the way of thinking, but in any other condition. But whether they have reserves to continue such operation, we will have to see. Now, another problem with small entity is that they are always full as far as the borrowing is concerned. You know what can be borrowed maximum amount, they are already borrowed from various lenders, various banks, and for further lending, unless something like Atmanirbhar Bharat scheme comes from government, where 3 lakh crores was a support given to smaller entities, MSME, or through NABARD or through other entities, smaller people were helped, and agricultural loans, something like that. All these people were helped by the government. Otherwise, that means the government was ready to give money without any guarantee. They were ready to give money where the loan with interest, the principal and interest, both were guaranteed by government, and no guarantee or no assets were required from the borrower, MSME borrower. Now, in such cases only, they would survive, or the going concern concept can be accepted. Otherwise, there is a great risk that the borrowers or the lenders or the banks may withdraw support to such entities, and therefore they are likely to be not a going concern in the immediate future. Small entities are likely to also lose supplier, customer, key employees, or franchise very fast. Now, this franchise, suppose I was having a franchise of a simple franchise of Domino or some such thing. I failed to pay Domino's over 2 months. They would just cancel the franchise as per the agreement. So the smaller entities may lose a key employee. Now, only one employee I have who helps me in manufacturing of small products in SSI unit. Now that employee leaves. Now either he dies, or he is in very serious condition, or he leaves for his village, and therefore I don't have anyone to in my organization to do manufacturing, even though there are orders. Now these kind of things small entities would face very seriously. Next slide. Now here the problem with small entities is that you cannot have a very detailed assessment like you can do in larger entities. They cannot prepare their cash flows. They will not be able to give you anything which supports them, have a supporting evidence that they will be financed by bank, or they have enough money with their relatives or friends who would actually finance them. It's very difficult to do a very detailed assessment, as I stated in the past. So there is no detailed assessment possible. So as an auditor, we are at a loss. Now, therefore, only thing is possible is the owners are many times engineers. If you see IIT engineers or others are owners of smaller entities for manufacturing of goods, or even traders. Now, if they have in-depth knowledge, they can be in-depth knowledge through hereditary passing of information also. So your father's father of the owner, they were doing the same business. So they knew. Now, the best case is Reliance, where Reliance, the owner, Ambani, he knew from his ancestor, or who knew from his friend, how to do that cloth business. Then he became owner's in-depth knowledge of the business, even in case of smaller businesses, and his anticipated future process, what he feels personally that whether he will survive or not, is the only way to decide for a smaller entity whether it is a going concern or not. There is no proof possible, no detailed assessment possible. We can discuss with management, that is that owner, for medium and long-term financing strategies, that whether he will be supported by his relatives, will be supported by his friends, will be supported by others in this financing. We should have only inquiry, inspection of documents to the certain for sales contract. Now he says, yes, now I got a contract from an MNC for future. You can check that whether that is one they will survive. Owner managers' ability to continue financial support and provide guarantee themselves. So they should have enough wealth themselves. They have suppose earned over last 30 years in this small business. It was from father's time. Now that person has earned. Now in that case, he says, I'll put back that money. I'll sell off my say agricultural land, or I'll sell off my other assets, but I will see that. So it is the ability of owner manager or a manager to continue a financial support to the organization should be checked from his personal wealth statement. And therefore, and then of course the written confirmation and support, if we can get, we should be able to check. Okay, now go to the next slide. Next slide, please. Sohail, next slide, please. Yeah. So here, what we are trying to look at, the use of going concern basis of accounting is inappropriate. Now, it is inappropriate if the financial statements are prepared on a going concern basis of accounting, but in the auditor judgment, that basis is inappropriate, and therefore you will give adverse opinion. Yesterday we talked of types of opinion. The adverse opinion is saying the accounts or the attached financial statement or enclosed financial statement do not give true and fair view of profit and asset liability position. Is saying that is an adverse opinion. So first thing what the standard says is, when you do not accept the going concern assumption and the management's use of going concern assumption in the accounting, you say these accounts do not give true and fair view because this organization is not a going concern. It is inappropriate. So that is one way of saying. I'll give you some examples of how the reporting is done. Next page. Now, the next one. Next slide, please. Sohail. Now, you also feel as an auditor sometimes that it is appropriate that the going concern, yes, it is a going concern, but there are a lot of uncertainties. Means there are several assumptions that the organization has made, and if those the assumptions look good today, or the information is well supportive of that assumption, but there is a uncertainty which exists. So there are two possibilities. One is the adequate disclosure is made by the organization, then I will give unmodified opinion, that is a clean report, and say I will add a separate section in my report. What are the material uncertainties relating to going concern which management has stated, and I have relied on that, and therefore I am saying I am not qualifying my report. So first thing is that I am saying that I accept the management contention, but I will have to write in SA 700 format. It's given there where to write it, that I am giving unmodified opinion, that is a clean report, saying that I accept, but these are the uncertainties that are there, and these uncertainties may result into organization being not a going concern, but today from the mitigating factor it looks like they will be successful. Now coming to the second scenario, that you are thinking that it is appropriate, that this is going concern assumption is appropriate, but the disclosure of material uncertainty is not made by the management, with a fear that anybody reading this may stop further financing the organization. So with that type of a risk, or that type of a apprehension, you are saying that no, I don't want to disclose anything. In that case, we can either think of a qualified opinion. Qualified opinion, I told you, can be on any one item or any one condition. But otherwise, if it is all pervasive, then again it will be a complete adverse opinion, because that information being not there in the financial statement can drive a reader to some other conclusion, that this organization is very strong, it will continue to be strong in future, because the material uncertainties you are not disclosing at all. I think the best report which you can read is a report of information technology companies. If you read report of Infosys, Wipro, they call it a future guidance. Now even quarterly report, they give future guidance. The future guidance is something where these material uncertainties are mentioned, that if I don't add to the new customers, then there will be a problem. There can be a problem that the parties have shelved the plans for expansion, and therefore all our plans of making softwares relating to that expansion may not work. So there are material uncertainties which are mentioned, and those uncertainties are read, and therefore the going concern assumption is taken as correct. That is, uncertainties are there, but there are mitigating factors, and this is being done. Now here, when the use of going concern is appropriate, but it exists, as I told you, that you should draw the attention in the note and state that the conditions may cast doubt, but the organization is still, I am saying it is unmodified report. And if the adequate uncertainty is not given, not disclosed, then you can always have qualified or adverse opinion given. I just read from here. We had, if some of you are interested in this particular subject, in October 2019, the chartered accountant issue, there is an article on SA 570. And this is available online also on our website of CA Institute, October 19 issue. Now there they have given some of the practical example as to how actually in practice we report. For example, there was one example given was the ABC Limited has accumulated losses on a particular date, and company also have a negative net worth. Now company is incurring losses and it has a cash flow issues. That means it has a negative cash flow, low level of business, fixed term borrowing is approaching maturity without realistic prospect of renewal or repayment, and it is unable to pay its creditors on due dates is the fact of the case. Now management has prepared account on going concern basis, and because it is hopeful of turnaround in future. But the auditor says, however, there are no concrete business plans, no evidence by promoters shown for equity infusion, no extension or sanction letters are available from banks and the lenders. And in such circumstances, use of going concern basis of account is inappropriate, and we want to issue an adverse opinion. So this is one example. Now, another example they are given there is that there are significant losses. Now again, the current liabilities exceed current assets, and significant defaults they have made in repayment of borrowings. Credit rating is also downgraded to default, and there are several things. There are several other such development. Now management has prepared a financial statement using going concern. When the auditor assesses, he says on the assessment of the successful outcome of monetizing his assets, a draft resolution plan, restructuring of borrowing, stake sale discussions, etc. I have gone through by the promoters, what we have done. Since the ability of the company to continue as a going concern depends on the ability of monetizing the asset or getting secured funding from bankers or restructuring, which is not wholly within the control of the company. Since it is not within the control of the company, I do not know whether this is this assumption is right. So I disclaim my opinion. I say I do not say whether it is true and fair. I do not know. It may be true and fair. It may not be true and fair. So with that, these two are the examples which are given there. And I think with this, I hope that I have given you the enough matter to think about as far as this particular subject is concerned. If you have any queries on this, I think you can always post it there in this. Can we go to the next 550? Sohail, can we go to SA 550? Sohail? Yeah. So there is another standard which is extremely important to us, because yesterday we discussed that in some cases, non-disclosure of related party transactions can be so important, because recently I got a balance sheet in which there are several things which are there, which are just through the related parties, and related party transactions are sometimes made, sometimes stopped, sometimes the values are changed, and several things are there, and the whole balance sheet P&L is dependent on related party debit and credit balances in the balance sheet, as well as all income and expenses are all to the related parties. Now such kind of things, when you sign, especially of a public company, even though it is not listed, it's very dangerous. You are taking a big risk of accepting something, and therefore this particular standard I thought that we will discuss a little further. Next slide. Now, what is a related party? As far as this is concerned, you know that any transaction done at arm's length, which is called arm's length, we'll see what it is, then it can be with related party or not with a related party, does not matter. So what is arm's length transaction? Because it is so much important that moment that these words are used even in Companies Act, arm's length transaction. Now, arm's length transaction is conducted on such terms and conditions that when buyers, sellers are willing and they are unrelated and act independently, pursue their own business interests, would accept a price. Now that price is accepted by these willing buyers and sellers, and they are acting independently and they as if they are unrelated. If that is so, then it is arm's length transaction. And if it's arm's length transaction means, I'll give you an example that I'm selling my car. I'm a car dealer or I'm a car manufacturer. I'm selling the car to my own director or the owner. Now that company is selling a car to the owner. Now, or as a dealer, he is selling it to the owner of the dealer firm itself. Now there, the same discount is offered, what is offered to normal customer. There is no change. Suppose I was offering a 10 lakh rupee car at 9 lakh 50, or I was buying an old car, a so-and-so model, so-and-so year model at 50,000. So I was giving 9 lakhs as a price, 50,000 discount and 50,000 price of an old car, which I would have otherwise also done with an unknown person, unrelated party. If that is so, then suppose everybody gets 20% discount on a cloth where he comes to my shop. Suppose there is a factory outlet, and factory outlet everybody gets 20% discount, and even my director gets 20% discount, or owner gets. Now this is arm's length transaction, because what is happening independent when they are not related also, if it happens the same way, then that is an arm's length transaction. So that is where the related party transaction, or whether it is with related party or not, doesn't matter. Now related party and the related party transactions are defined in AS 18, related party disclosures, and AS 18 is the basis on which these auditing standards can be read. Now, who is a related party? A person or entity that is control or significant influence on the entity, or entity under common control, common ownership, common key management personnel, that has dominant influence in making financial or operating decisions. Means somebody else takes my financial decisions, somebody else takes my operating decisions, then those are called related parties, who are completely controlling my business, my ownership of my business, the actual operating decisions, operating management, financial management are controlled by such persons. Whosoever he is a related party. Go to next slide. Next slide, please. Yeah. So we have a higher risk of material misstatement in financial statement. That means when it is a related party transaction, related party relationship makes it a higher risk that the financial statement may be faked, or may be tweaked, or may be changed because of related party transaction. It is a higher risk. When I'm dealing with an outsider, there's a lower risk, because still arrangement can be made with an outside party also of such type, but it is less likely. More likely it will happen with a related party. For example, if I want to shift profit out, I am putting some expenses in the related party's name, and I'm shifting out the profit to a related party by putting some expenses or some payments for consultancy given to related party. So there is a higher risk of material. What is a materially misstated here? Profit. How it is materially misstated? By putting expenses which are actually not expenses of business or not related to business, but shown as a business expenditure. So here I am at a higher risk. So how I do it? There are many cases given in the standard, and one is of course extensive and complex range of relationship and structures. So this was one thing that was used in ILFS. I don't want to discuss ILFS here, but here even this was used in several international frauds. If you see the complex structure being used by Enron, when Enron failed, they had made a complex structure of partnership firms and proprietorships, and all the losses were parked there, all the profits were parked in Enron. Now these kind of things were always done, and a very complex structure. You do not know who is the real owner with whom you are dealing. Now, in case of ILFS, they were dealing with their subsidiaries, which in turn had joint ventures, and joint ventures, the partners were their own people from other side or whatever. Now, then, you don't know who is owning the particular project, who is doing what, who is dealing with the company, how it is profitable when apparently it is a loss-making project. So it's very extensive or complex range of relationship. You do not know who owns what, and therefore it is possible that such transaction can happen, which gives a materially misstated financial statement. Ineffective information system. Now then, when you have a system by which you identify the related party relationship and you identify the transactions which is party, there can be highly ineffective system by which such identification becomes impossible or such identification is inadequate. Now, when that is the system, especially with smaller entities, you have a serious issue of finding out a related party first, then the relationship, what it is with the this organization, and the transactions. And transactions which are not conducted under normal market conditions, that is, you can have, you are giving your place to a related party free of charge. Now you have a building and a related party is given a floor in that without a rent at all. Now it's very difficult for you to understand this as an auditor, that these related parties are using assets of your organization without any charge. This is misstatement, 100% misstatement, but it is very difficult. But the risk is highest when such transactions are with a related party. Next. Now we go to the responsibilities of the auditor. Now, responsibility of the auditor, I will just come to, So, what are the responsibilities of the auditor in case of related party? They have to perform the audit procedure. What audit procedure is performed? First, to identify a related party. Then assess and respond to the risk of material resettlement arising from entity's failure to appropriately account and disclose the relationship, transaction, and balances. Now, here, as an auditor, I'm trying to say that first of all, I must have some procedures known to me, or some procedures which I perform on the accounts, on the financial statements, or on related documents, that how I identify, assess, and respond to this kind of material misstatement, where the system itself does not account for such related party transactions. Now, you have to be absolutely alert to the related party transactions, and the SA 550 on related party, para 822, gives a lot of information how during audit, auditor can inspect which kind of records and document which will provide him some information on related party transaction. There is a whole list there. I will just highlight some of them. The standard says you can look at shareholder register to identify entities, principal shareholders, and therefore that can be a related party transaction. You can read the contracts and arrangement with key management personnel or those charged with governance and see whether such parties have anything to do with the actual transactions with such parties. You can look at significant contracts which are renegotiated with any entity. If the significant contract is renegotiated, it's likely that it is a related party, and therefore such renegotiation may happen. You can look at internal auditor report, who is given responsibility of identifying such parties. Or you can have the document associated with entities filing with security regulators, like the prospectus. So there are several things other than the normal accounts which are available to you as an auditor to say that this is this particular thing can be identified by you. The second thing that is can be done is the problem with the auditor is responsibility of the auditor is enormous. But here you will find that there are inherent limitations of audit. Now, what are the inherent limitations of audit? All of you are already aware of inherent limitations of audit. I don't think I have to state them specifically, because one of the limitations in audit can be the cost considerations. Now, there are cost consideration with the audit. You have an audit fee agreed, and with that audit fee agreed, you have a limited time in which you need to complete. So you have a time limitation, you have a cost limitation. Now there is a sampling done. Another inherent limitation of audit is I don't check 100% record in very, very large organization. I go by sampling. Now use of sampling is inherent limitation of audit. The absolute assurance versus reasonable assurance means what I'm trying to give is a reasonable assurance and not absolute. Yesterday also we talked of these concepts. And when absolute assurance I'm not giving, it is an inherent limitation of audit. The use of various judgments and estimates is also a very, very great limitation of audit, because of which such kind of things can be then there is a persuasive evidence rather than conclusive evidence on various things. Now, therefore, the risk of detecting such type of frauds or errors become less and less in case of material misstatement, if possible, in case of audit of any accounts. You will find that auditor is unable to get, even though he is responsible to get such a thing identified and get reported, he is unable to find that. Go to next. Now there is something called presence of fraud risk factor. Now here the essay 240 is on fraud. I have given lecture in Nashik on fraud, and I hope you remember at least some part of it, or we can have it once again revised. Essay 240 says that in case of related party transaction, there is a greater opportunity for collusion, concealment, or manipulation by the management. Now, these three things, whether it is collusion with other party, concealment of information, and manipulation of any transaction, is more possible with a related party, and therefore auditor should take it as a presence of a fraud risk factor. And whenever such a factor is there, he has to take a lot of other related work he has to do. He has to get a lot of other confirmations. He has to do alternative audit procedures to find out what is right and what is not right. So they are saying in related party, when it is present, this is definitely a fraud risk factor when I depend totally on a related party for many things, and therefore you should be much more alert. Therefore, requirement of professional skepticism is to identify the related party. Now here requirement of what is a professional skepticism? Professional skepticism is that to be alert to the conflicting information I'm getting during audit. So one part I try to get the information is one evidence, another evidence is from another source, and both don't tally. Now, when that is there, that is called professional skepticism. You are having a, everything is not doubted. It is not asking you to doubt everything. But when there are indications that something is wrong, you cannot let it go. So this particular part of responsibility also requires auditor to see that related parties are properly identified. Go to next. Next slide, please. Yeah. Now, to conclude that financial statements are true and fair presentation of related party transaction, you have to have a procedure followed. Now, we will see the procedure very soon, what I need to follow. But what I say is that there is a separate procedure to be followed to find out that financial statements have a fair representation of transaction. Now, finding again sufficient and appropriate audit evidence that related party transactions have been properly. See what we do. We identify a transaction. We see that first identify a related party. So first list, AS 18 requires us to give three things. First is you identify the related party and see what is the relation. So I write a related party and write a relation with that party. If it's an individual, we say relative, father, mother, etc. If it's a company or an organization, we say partner in so and so, or a director of so and so, or the holding company, subsidiary. So relation. Then I also look at the transactions, if there are transactions with such parties. And at the end, I look at the balances with such parties at the end of the period. So all that, whether these transaction parties have been identified, transactions has been listed, accounted for, and not only listed, it is also accounted properly in the books, and it is disclosed in the notes to account appropriately, is what we need to see. Next slide. Now here, what other things we will do is that transactions, if they are in the normal course of business, obviously you will not have any issues at all. That there is no risk of higher material misstatement. But AS 18 requires us to do all these things. I told you that to understand the nature and actual or potential effect on financial statement of related party transactions, as I told you, that transaction done at 5,000 rupees for a place which should go on 5 lakhs rupees, suppose rent, that itself shows you that how much risk you are carrying in audit when you are accepting such kind of things. So that is where your identification of the transactions need to be seen. Now, identification of the transaction also depends on related party relationships, where management may not provide with you with the information. Go to the next slide. See, here the audit procedure is given. How you really find out. You can check confirmation, bank account, minutes, entities ownership, way entities is structured, internal audit reports, policies and processes for timely display, etc. Next slide. Check responsibilities, who is having responsibility for identifying that such transaction, recording, summarizing, disclosing. You talk to that person and see how you are identifying. Check the procedure that they are following to identify such transaction, because in case of the management which is completely professional, it may be difficult for you to do this, and therefore I mean professional, you can ask them the process, because otherwise they are not interested. So you are asking for the process. You can also check tax returns, information with regulatory authorities, how it is filed, or shareholder register, or under Companies Act also there are declaration of interest of directors, contract arrangement with related parties, guarantee and guarantor and guarantors. For example, if I'm a guarantor for somebody else, then I have an issue where we can, why I have given, why I'm a guarantor for somebody. I get this information from another, related party balance sheet. So that I have given guarantee to certain organizations. So here is a way of finding out how we get a related party transaction from various other documents we verify. Next. Now we need to inquire with the management about this, what they are doing and how they are doing, what is their process of identifying, especially when the management is completely professional. Then nature of relationship, transactions, as I said, authorization, who authorizes this? For example, in case of limited companies, the audit committee authorizes all related party transaction, or a board authorizes when there is no audit committee. So who authorizes, who approves, and at that point of time, whether a note states what is the discount given or what are the adjustments made with related parties, and any transaction which is outside the normal course of business, then what is the business rationale? In business rationale means why I did this transaction. Suppose my business was not renting the properties, but then renting a property to a related party is outside course of my business. And then what was the business rationale? I have excess space in the building, and there are a lot of charges I pay, and to cover those charges I am paying. I'm giving it to a related party, but am I giving it market rate is a question. So here I must know why I'm doing this. What is the business rationale for a particular transaction being done at a particular value will be important to all of us. Next slide. Now here there are a lot of fraud factors that you can consider. There are unincorporated entities. There are various other things that are done in the organization that misrepresents the financial position or performance. Use of business partners of KMP means the key management personnel's relatives are actually business partners or their friends, and they are used to misappropriate the assets. Then management can override the controls by creating some fictitious transactions and that will design, which is designed to misrepresent they are as if they are right kind of transactions, and actually the values are the assets are being taken away. In Caro, we have a question on the transactions with directors, which are non-cash transactions. Now, non-cash transactions are done in this is a fraud factor. Now, what I do is I create a company. I value that company share at 400 rupees, which is actually the price is 10 rupees, valued at 400 rupees. How it is valued at 400 rupees? By saying that there are great prospects to this company, which they hold a license, and that license when actually used can have a great use, and therefore great profitability possible, and therefore the value of a share is made at 400. Now what is done is the assets of the company are transferred to that other organization, and shares are obtained against that at 400 rupees, 100 rupees share. This is a non-cash transaction. Therefore, Caro requires us to mention all non-cash transactions with the directors or the KMPs. Now, such type of non-cash transactions, this is a fraud factor with a related party. Now, such type of transactions are to be seen. They are at above market value, below market value, both are possible. Transferring profit from one organization to another organization, it is not necessary that I always do the transaction above market value. I can do it below market value to get the profit of other organization, related organization transferred to me. And therefore, many times, suppose I can either reduce the rent below market price, below market rent, and transfer my profit to a loss-making subsidiary, or I can do reverse. The profit-making subsidiary's profit may be transferred to me by overcharging for something. So all sorts of things are possible, or the fraud factors we need to have a consciously being looked at as to what is the how I must go for it. Yes, next slide. Now there is a next. This is of course domination of management for single person, small group. Again, this is a fraud factor. No discussion regarding business proposal initiated by a related party. So audit committee or nobody is discussing. When it comes from the owner, nobody discusses. Just accept. Then unusual high turnover of senior management and professional advisors. Now here the people are coming, the professionals are coming and going because they are very uncomfortable in this situation where there are frauds happening through related parties. So this is one of the indicator. Use of business intermediaries for transaction. No clear judge. For example, I can always sell in the market. Instead of that, I create an intermediary of related party so that profits of the company are hived off or transferred to a related party, and from there taken out. So this, when there is no justification, all my competitors are selling direct and I am going through the dealers network, which is all related party network. Now, this is something which is a fraud factor. Next. Now here, identification of unidentified or undisclosed related party means unidentified related party or undisclosed related party transactions. Now, suppose you are auditing and you identify a related party which was not given in the related party list by the client either in this year or previous year. Now you have identified such a party. Then what you should do? You should first promptly communicate. Now what you should do is promptly communicate to your other team members. Then also tell the management that you quickly have I request the management that you tell us of all the transactions with this related party, which in our opinion is a related party, and inquire why the management did not give this name to me. Why this party was never identified as a related party when auditor has identified or audit has identified it as a related party. What is the reason for failure? What is the control failure? Controls have failed in this case to identify a party and disclose such a relationship, and therefore also this non-disclosure of transaction with such party. So I'm trying to say that why this happened and how this happened. I know, for example, I'll give such a case when we found it in audit. When we were auditing a group, in one of the cases, one of the entity we found that there is a loan from the bank against fixed deposits. Now there were no fixed deposits with this entity. This entity had no fixed deposit. So when the loan was written against the loan which was taken, that secured by fixed deposit. Now, since there were no fixed deposit, there was a doubt that whose fixed deposit is. They are the directors, or they are of any third party. So we inquired, and then they said, let us ask the bank. So we asked the bank, and bank gave the disclosure of the fixed deposit. Now then we understood these fixed deposits are actually of another party in the same group, another company in the same group. Now that company has never disclosed that they have given their fixed deposit as a security against loan taken by a group company. So this guarantee was never disclosed. This was a related party transaction, that I have given a corporate guarantee or I have given a guarantee in terms of my fixed deposits against the loan taken by my another subsidiary or another group organization. This was the related party transaction which was never disclosed. Now this kind of things can happen, and therefore a related party transaction which is identified, you have to be immediately asking the management what is the reason for the failure of this particular identification, or why this was not identified. Next slide. Now you have to perform your own procedure relating to newly identified related party. Reconsider the risk that other related parties may not have been identified, and there is a significant related party transaction which is not identified. There are two risks. One is not identifying a related party. Second risk is identified parties, all the transactions are not recorded. So both you reconsider this risk, that some of the related party may not have been identified by the management, either due to fraud or error, either way, fraudulently or by error, and or do the identified related party you have been given only small transaction, and real big transactions or real material transactions are not been disclosed, and therefore you are able to disclose it. You reconsider how to manage this particular risk. If non-disclosure management, if it appears intentional, now you know that why they did not do. When you get the transactions, when you get the balances, you know why they don't do. I went for a stock audit, very simple thing. I'm giving. I went for a stock audit, and in a stock audit, I found from the accounts of that party that one credit, he had only 10 lakhs rupees, as you know, those days, long time back, a CC account, 10 lakhs rupees limit. Now, when I went for checking, I took debtors and stock and everything, and then I realized there are creditors. And when I checked with the bank, with the information given to bank, one creditor was not shown in that particular statement. Now, when that creditor was not shown, I asked, what is this? So it was a creditor of 5 lakhs. He was a dealer in tire. And he says this stock was defective, and therefore I'm not going to pay for the 5 lakhs. I said, okay, assuming it is a defective stock, where is that defective stock? It doesn't appear in your stock statement as zero value, that there is a stock lying here for which there is a liability booked, and the stock was booked, and maybe you have written it off. The stock but the liability exists. Actually, both should have gone out. He says, no, that I don't want to pay. I have sold out the stock at lower value, whatever value I could, but I'm not going to pay this party. Now, this kind of non-disclosure appears intentional. This non-disclosure to bank by this particular trader was intentional. That why it was intentional? Because had he shown this as a liability, his ratios would have gone for a toss. Current asset minus current liabilities. Now that it was intentional non-disclosure. Here we are talking of related party transaction. I just gave you an example how it is intentional non-disclosure. So it appears intentional. If it appears to you that it is an intentional non-disclosure, you have to evaluate the implication on the audit of such non-disclosure, reevaluate the reliability of management response in your inquiries and your representation made to you. Now here what happens is 95% of audit is on faith. You are accepting, you ask on verbally and you get reply verbally. Now this faith itself has an issue here, that if it is an intentional non-disclosure, your other representations received from management, either written or oral, are in doubt, that he may have misrepresented there also. this person intentionally does something wrong, and am I satisfied that all other representation received from this party are okay? Now with this kind of things, we have to be very cautious. I have to think as to whether I am on the right course. Next slide. Now, how they do it, how these transactions are done, which are outside the normal course of business, and which are, because as we said, that it can be a complex transaction of restructuring, transaction with offshore entities. You do not know that these offshore entities are related parties. This was done in Winsome Diamond. In Winsome Diamond's case, when they said that the parties in the foreign countries have refused to pay, all the parties were giving the same reason for non-payment. Then when the inquiry was made, it was found out that all offshore entities were nothing but the proprietorships of the same person who was on the Indian side, and there were no other entities. So he was selling to himself in the offshore and showing it as export sale. And all these years he was remitting the money, but when he stopped remitting from there and used money outside India, and the owner himself ran away outside India, offshore entity transaction, a related party transaction, which bank never knew in the past. So this kind of things happen. Leasing of premises with no consideration, sale transaction with high discount or return, then transaction with circular arrangement, a sale and repurchase transaction, transactions whose terms are changed before expiry. So when the party is about to fail, you change the terms. There can be unusual interest rates, that is very low interest rate, either 2% or 21%. Either way, unusual prices are being paid or adjusted or agreed, and repayment terms are also agreed. You can have a loan without a security, unsecured loans are given to related parties. So all sorts of things are done about this related party transactions which are outside the course of your business. Next slide. Now, you have to inspect the contracts and evaluate whether there is a business rationale or complete lack of business rationale. If there is a complete lack of business rationale, then this is a fraudulent financial transaction, fraudulent financial reporting, and it can be a concealment of misappropriation of assets. Actually, the assets are being, I told you the example of 400 rupees. Rupee share valued at 400, those shares are given against the property which is transferred to that company. It is a complete misappropriation of asset concealed under a related party transaction. Terms of transaction consistent with management explanation, transaction appropriately accounted or disclosed. You have to see whether significant account transactions are properly identified and properly disclosed, all transactions and balances. So we have to update evidence that they are also authorized and approved. All related party transaction needs authorization, because that gives the thing that the management takes the responsibility of all this. All these transactions is what is important. Next slide. The arm's length transaction assertion. The management support of assertion regarding that management is claiming with you that this is an arm's length transaction. Then if they are claiming, they have to give us the comparative terms of identical or a similar transaction, or we should go to market and see what are the terms. If that is proved that yes, I gave you example of a car dealer selling it to his own director. Now, if I can have a proof that all other transactions are happening, which are identical or similar transaction happening the same price, then I will say yes, it is an arm's length. Engaging, otherwise I have to engage an external expert, either by the company itself or myself, that to determine what is the market value. Now I find that a big asset has been transferred to related party. They are saying yes, this is as per the market price. Now I can always go appoint an expert, go to sub-registrar office and find out at what rate these properties were actually being sold at that point of time, and what is of course the stamp duty value, and find out whether this was at arm's length or not. So there are ways of finding out for you an arm's length transaction. So I think with this, go to the next one. Other requirements as per standard is, in case of all related party transaction, we should have a written representation. If we have issues with this related party transaction, which are either not identified or identified and not disclosed, or all transactions with a related party are not disclosed, communicate with those charged with governance. and you need to completely document whatever decision you have, whatever decision you take. You have to completely document with you that how you have arrived at a particular conclusion. Let us go to the last standard, which I'll take, SA 560. Now, friends, there are subsequent events. What are subsequent events? Events that have happened after the date, events that are subsequent to the date of financial statement. Next slide. See what is a subsequent event. This is, there are events between the date of balance sheet, date of financial statement, and the date on which you are signing a report. Now, there are two kinds of events. That there are several events that happen in any business between these two dates: the date on which we sign the financial statement and date of the report, financial statement, that is 31st March, to say we sign in December. So now this is the period in which there are some events which have happened in business. These events have two parts. There are two types of events. Some events are, they provide the evidence of the condition that existed on the date of financial statement. And if they provide some evidence of what was actual condition on the date of, and we'll take an example of this, that what was the condition on the date of 31st March, what was the condition? I came to know about it in September. Now that September, if I come to know that there is a condition, I have an evidence that condition what existed in financial statement date, and the value I have taken of a particular transaction or a balance is different, then I need to adjust that transaction amount or a balance. This is called adjusting event. And there are some other evidences which say that there are conditions that arose after the date of financial statement. The conditions they are not dating back to the date of financial data. They are not dating back to the financial statement, and therefore they are not relevant to me for my audit. So the subsequent event, part 1, is relevant to me because it adjusts my figures, and the item 2, which says that these arose after the date, but there are no adjustments which are required. We'll take examples of this. Go to next. Yeah. Now there are 2-3 things where we should know how this is done. There are events occurring between the date of financial statement, date of auditor report, but the facts are known to the auditor before the financial statements are issued. Now, facts known after financial statement are issued, you have very less control, because then there are procedures given in the standard as to what I do if I know after that. But if I know before that, what is to be done, we will discuss, which is more important to us. Yeah, next slide. Now this is about the response of the auditor. Now we have to see what we have to see here. We have to check the procedure design. First of all, there has to be a procedure in any organization which is more formal to identify the event itself. What can be called an event, which is a subsequent event. First, to identify the event. How you identify it? If there are written minutes, you can identify minutes. You can check the bank statement for a subsequent period to identify an event. You can make inquiry with management that what are the commitment, borrowing, guarantees, etc. you have taken subsequently, you have acquired asset. Now, acquisition of an asset, for example, in a subsequent period, may indicate there was a capital commitment on the date of balance sheet. So it dates back to the balance sheet, at least to show it as a contingent liability, that I have entered into a contract in March to buy an asset, and there was no indication, there was no advance also given. And in that case, I was not aware. So if the minutes are written, I'll know from minutes. If the minutes are not written, I'll know from subsequent bank statement or for subsequent accounts that there is an acquisition of asset for which the order was given in February or March. That means there was a capital commitment which I have not shown as a contingent liability. So like this response of the auditor will come from looking at a subsequent event about the various things, like read subsequent interim financial statement. You can have of course, the written representation relating to this particular item as to how we can look at it, and ask for a written representation that all these subsequent events have been listed, and you have identified the events, and then put it into two sections, one which is adjusting event, another which is a non-adjusting event, and therefore we can always do the adjustment or ask for an adjustment of a particular item. For example, if there is a court case, now court case, the result has come after the date of balance sheet, but we have not taken it. Suppose it has gone totally against us, or some assessment has gone completely against us. Now we have assumed that I am able to get a refund. I should have a refund in sales tax, refund in VAT, refund in service tax, refund in GST. We have mentioned that in balance sheet, and subsequent even indicates that it has been other way around, that actually we paid taxes instead of this. Now such kind of event where decision of the court cases go against us, or our debtor, where I showed that the whole amount is receivable or 50% is receivable, only 50% I provided for debtors, and debtor becomes completely insolvent and nothing is received after the date. So such type of events would date back, because this is called estimate. Recovery of debtors, or saying that there is no bad debt provision required, or only 50%, 5%, whatever is required, is an estimation. This estimation has gone wrong. A subsequent event indicates that the estimate was wrong. A decision of a court case will come in my favor, but it my estimation, therefore it is a contingent liability, and therefore I need not provide. This has gone wrong. In fact, I paid the penalty in the next year. That itself shows that on the date of balance sheet, this was not really this was a liability and not a contingent liability. So these kind of things we need to see as a response to by the management. Next. This is that we discussed that, see the question. There are two questions to be seen by the auditor. One is whether the amendment to financial statements are made, disclosures are properly made. If the management refuses to amend the financial statement, then obviously the auditor will have to see whether he wants to give a qualified report. But the check events relevant to measurement of estimates and recoverability of asset, check events which call for question the validity of going concern assumption. Some of the cases the plant is completely destroyed, suppose by fire next period, or my license under which I was doing the business itself has been lost by me, or because pollution control board said you cannot run your factory at all and this factory is closed. So these kind of subsequent event would not date back, but would have a serious doubt on going concern assumption. So subsequent events, if they date back, like the debtor's insolvency, or the contingent liability becoming actual liability at a subsequent date, etc., is something different. And this is where is one way. And second is, there are subsequent event which says that this company or this organization will not survive for next 12 months. Now this is the going concern assumptions which is under challenge. So we will have to consider even that as a response of the auditor to the subsequent events, whether they date back or they do not date back. So even though they do not date back, at least going concern assumptions will be in trouble. Next slide. So one is management accepts the amendment to financial statement and disclosure. Then you say that you actually change the accounts and you present it and then sign it. You have to show the emphasis of matter paragraph in the auditor report can be used in this case to say that accounts have been adjusted. See the note number so and so for a subsequent event, which gave us more idea as to the values of assets and liability on a particular date. And if the management completely refuses the amendment, obviously you have to see that there are two ways of looking. If they don't do it, you can qualify, saying that there is a subsequent event because of which it is not a going concern. There is a subsequent event for which the debtor's recovery is in doubt and it is not, will not be recovered at all, or a liability has been shown as contingent but it is not. So you have to see, or it is not shown as actual liability and shown as contingent liability. Now what is the effect on balance sheet and true and fair way, you will have to judge, and you either qualify, give adverse opinion, or whatever you have to do. This is one, when the report is not signed. But if the report is signed and you came to know about a subsequent event, which was so substantial to say that the financial statement signed by you do not give a true and fair view, then auditor should seek the prevention of future reliance on his report. What it means is that you have to tell all the respective people, like you have to give public advertisement to the shareholders saying that don't rely. You have to write to the bankers saying don't rely. You have to write to the income tax saying that this is uploaded, but this is completely incorrect balance sheet, and this sales were overstated or expenses are highly overstated or whatever it is. Now this is don't depend on my report. So auditor should seek prevention of reliance on his report by the users of the financial statement. A subsequent event where no adjustment is possible and the management or the management refuses to give anything in the financial statement, any adjustment for such kind of events, and a report is already signed. But if it's not signed and they refuse, then also you can give adverse remark or a qualified report. Next slide. So with this, I think I completed my presentation of 3 auditing standard. It took a little longer time and has little less time for my friend to give to deliver his standards of all risks. And there is a risk in you not understanding him properly because he doesn't have enough time. But I think still we will try to find what risk he is talking about in the assessment of risk in the audit. With this, thanks a lot. Thank you, all of you, for giving me this opportunity, Rohan and Sohail both. And with this, I request you to introduce our next speaker.
Thank you, Srinivas Joshi, sir. Now, I request our second speaker for today, Abhijit Sansgire, to take over the charge. So before taking over the charge, let me introduce our today's speaker. Sir is chartered accountant and LLB by profession from past 30 years of post-qualification experience, has worn various hats of over the years of CFO in listed companies, head internal audit, entrepreneur, consultant, examiner, keynote speaker, interviewer, author, mentor, and blogger. Speaks extensively on branding a professional as a tough leader, authoring a book, content writing on LinkedIn. Care professional, compliance, audit, risk and ethics, philosophy of HUT, MAD, being helpful, useful, relevant with trust to make a difference. With this brief introduction, I request our today's speaker, Sansgire sir, to address the members for today's seminar.
Yeah, thank you.
Just a minute, Abhijit, just a minute. Before you speak, there are 2 relevant questions for both of us in the chat. One is they are saying instead of modified opinion, can I make a disclosure in the notes? Friends, I think yesterday I told you that disclosure is no substitute for an adverse or that is a modified opinion under 705, 706, 705 especially. You have to give adverse opinion, you have to give any disclosure saying that yes, I made a mistake or I should have adjusted accounts and I have not adjusted. No disclosures in notes can prevent an adverse opinion being not being given. So, and the second question is about the there is a transfer pricing assessment and that has increased your profit, suppose, and therefore whether it's an event which is adjusting, most of the time no, because you, even though you accept or don't accept TP assessment, is for some other reason, your way of billing or your way of adjustments do not change, and if they really change, then only there is a question of writing about it. Otherwise, a TP assessment by itself is not an event which will adjust our accounts in the past. Unless you accepted that, you got the additional, charges made to the foreign party or the Indian party, related party, and therefore those charges are prior period in the current year. So you need to go back and change your previous year accounts and show it as sales or purchase or whatever. I think with that adjustment, if you accept, then it is required. Otherwise, in TP assessment, it is not required. With this, I think I'll hand it over to Abhijit for his excellent. No, I know his deliberation I've heard in the past. So let us enjoy that. Yes, Abhijit.
Thank you, Srinivas, for this wonderful remarks, and thank you, Nashik branch, for giving me an opportunity to basically speak on the standards of auditing. I would be very frank to admit that whenever I get a speaking opportunity, it gives me this time to just go through the standards of auditing. And I know many professionals, including me, who who had read the standards of auditing only when they were there for either my IPCC exams or they were there for my final CA exams. And post that, I think it was all codified common sense, and we were doing what we thought was logical. I think that's what, when you talk of risk, everybody knows risk, but nobody knows risk. So it's we all make assumptions that we know something and we do as per logic, but what exactly do the standards require us to do? I think the standards require us to do a lot of documentation, and it's very specific. Now, are we really structured, and are we really very specific when we comply with the standards? Because standards are mandatory. So let's take a brief view at all these standards. Some important aspects, I'll just go through that. It's basically all of you would be knowing this, but it would be a revision. At certain point of time, I would touch certain things which practically are needed to know or to specifically emphasis on. And if there are any questions at any point of time, I would be willing to answer or brainstorm anything. Everybody would have a different view or opinion, and let's go through this. So one is your SA 300. So we are taking SA 300, 315, 320, and 330. Now, SA 300 is on planning and audit of financial statements. Like every essay, it has 5 parts. So first is the introduction, the scope, the effective date. Now this essay 300 is effective from financial statements from 1/4/2008 onwards. The objective, the requirements. It has application and other explanatory material and an appendix wherever needed. And in the requirements, one of the key requirements is of documentation. So that's the crux of the standards of auditing. It requires us to specifically document. Now, why these standards? So the standards are nothing but systematic guidelines which help determine the steps and procedures we need to carry out. Section 143(9) very clearly says they are mandatory, so we need to comply with them. If there are any deviations therefrom, they need to be disclosed. So they are needed to assure or ensure accuracy, consistency, and reliability, improve effectiveness and efficiency of audit. It's a yardstick against which audit quality will be evaluated. And there are generally 3 types of these standards. One would be general. One would be specifically requiring us to do certain field work, like SA 320 would be generic, SA 300 would be generic, but SA 315 and 330 would be specifically requiring us to do certain field work. And then the reporting, the 700 series, which has been talked about, they are specifically reporting standards which require us when we report to take care of certain things. And all the documentation which is there is a part of field work which one needs to do. So every standard, though it will have something which will be there, it will be reporting which one will need to do and have in mind. So now what does SA 300 overall talks about? It talks about establishing an overall audit strategy and plan for an audit. So when you're doing an audit, you'll have a strategy and you'll have a plan. Now, what is a plan and what needs to be stated in the plan? It needs to be a detailed one. So you have a strategy and you have a plan. Now, what is in it that you need to plan is what is specifically stated in SA 300. Basic questions is who makes the audit plan? What should be documented in the audit plan, and when should the planning commence? So these are all questions one needs to address. So who will make it? So is it that the partner makes it? Is it that the chartered accountant who's handling the audit does it? Or is it that your article will do it? So this is basic fundamental questions which one needs to address. Let's assume that even if an article is made, is it finally reviewed by a chartered accountant? And finally, is it reviewed by the partner who is signing off? So basic stuff which needs to be understood and which needs to be documented. Then if you're documenting, what exactly will you document in a strategy and what exactly will you document in a plan? Now, one is how many audits would actually document a strategy? This is my strategy for this year. This is how I will go about it. this is something where I believe we lack a structure. So it's not that we don't know the standards of auditing, everybody knows it. But frankly, if one really asks, how much have we documented what is necessarily required to be documented, I think a lot of us would come up proper. And that's where I think the education series is very important, because the more and more we talk about it, the more and more we know about it, and the more and more we speak about it, we would do it. And if it's a chain reaction which starts, so if I have documented something and it's a part of my work paper and it's being seen by somebody else and it's a good practice to follow and carry on, then everybody would start doing it. So one, I think it's very good to have these knowledge series and actually learn. So who makes the audit plan? What should be documented and when should it commence? So these are basic questions all of us know, but whether we have documented it and whether we are strictly following it in the manner in which one needs to do is what is the standard all about. Now, this standard, the scope deals with the auditor's responsibility to plan and audit of financial statement, yes, in the context of recurring audits, and maybe any additional consideration for initial audit engagement. You are doing it for the first time, maybe you may need to plan it in detail. That needs to be taken care and it needs to be documented more in depth. So the objective is you plan an audit so that the engagement, the audit engagement is performed effectively. So it's finally the effectiveness of audit is what is the purpose. So to perform an audit effectively, you plan and you strategize. So who would be involved? So ideally the engagement partner and other key engagement team members to be involved in the audit planning. So the engagement partner clearly has to be involved. It can't be delegated to anybody else. So if there is a plan and there is nowhere the involvement of the engagement partner, so even basic issues where somebody has signed off on that audit plan, and if the engagement partner is not a part of a team, as a peer reviewer, I could really take objection and say that this has not been complied with in total. So be very clear, the requirement of the standard says specifically something is to be done, then it needs to be done because the standard is mandatory. And why? So there is a purpose behind everything which is done. The AASB of which I think Srinivas would actually go into, and I think you should have a 15-minute discussion of how actually the standards are really made. It's a collective wisdom of a lot of senior members. So maybe each standard would have an experience of more than 1,000+ hours of members who would have cumulative audit experience, who would have gone in making these standards. So again, same way, like it's planned, it's strategized, and then it's made. So the same way, when you're auditing an entity, involve all the key team members and as well as the engagement partners, so that you benefit from their experience, the insights, so that it increases the effectiveness and efficiency of planning. So as and when you involve more and more members, yes, you will get diverse views. See that too many people are also not involved, as too many cooks will spoil the broth. So see that it's the key members who are there. The engagement partner clearly has to be involved. So one is, it starts with your preliminary engagement activities. So here, one key point about the essays is all essays are interlinked. So one essay will talk about something which the other essay will require, and finally essay 230, which talks of documentation. I think it's a generic standard on documentation, but each standard of auditing will specifically tell you what is the documentation requirement. So to that extent, all standards of auditing are interlinked. Now, essay 300 tells us to perform procedures as per essay 220 on quality control, and that's with reference to continuance of client relationship and specific audit engagements. Now, even the compliance with ethical requirements, including independence as per essay 220, has to be initially looked into. So when you're planning an audit, you have to take into account that when whatever you are planning in performing an audit engagement, you need to take care of your quality control, as well as you need to take care of your ethical requirements, all about independence, objectivity. There should be no conflict of interest. So the entire planning has to be in consonance with essay 220 also. Now, even the planning has to be in accordance with essay 210, which talks about the terms of engagement, understanding what the terms of engagement engagement is maintaining your independence, maintaining your integrity, having complete clarity of understanding, ensuring there is enough competency in the team which is conducting it. So everything has to be planned. So what exactly, how do you plan? What do you consider as a part of planning is all listed down. Very useful, very generic content, and a read would surely help our perspective in actually planning, and it would give a real structure to the planning. So what is strategy? So strategy is clearly defined as per the standard. It clearly says you basically identify what are the characteristics of the engagement, the scope of the engagement, what are the reporting objectives. So once you know what the objective of the audit is, then you can plan your timing, the extent, the nature, what you need to do, how would you communicate, to whom you would communicate, who is the management, who is charged with governance. Now, what are the key significant factors, what you need to check, how would you direct the entire audit team efforts. Then you need to consider results of all the preliminary engagement activities you have done, or maybe the knowledge which you have gained from other audit engagements, and then use that in the planning process. And finally, based on all this, you'll also need to determine the nature, timing, and extent of resources you'll need to perform the audit engagement. So what exactly needs to be done? So finally, you'll have to give a true and fair view. You'll have to certify the cash flows. You'll have to get in, also look into other accounting standards. So somewhere you have AS 320, you'll have to document materiality. So when you strategize, what exactly are your materiality levels? You have SA5T on written representation. So what written representations you will take, at what stage you will take. So they'll be all a part of your audit plan and your audit strategy. So this standard can't be looked at in isolation. This will have to be looked at in consonance or in sync with all other audit standards, and accordingly you will need to develop an audit plan. So what exactly this audit plan will also include will be the nature, timing, and extent of risk assessment procedures which you need to do as per SA 315. And then if you find out that there is a risk, then what would be your response to the assessed risk? That's covered in SA 330, which we'll quickly talk about. So that also needs to be factored into the planning, is how would you assess what is risk and how would you comply with the risk, and maybe other audit procedures which are needed to comply with other standards of auditing which we need to do. And as and when you do the audit, you will get more and more info. I think you'll be more and more finer, and you'll need to update the audit strategy also if it needs to be updated, and maybe the changes in the audit plan which we need to do. So somewhere if I was to do the audit in 31st March 2020 and I was sitting on and making a plan on 1st March 2020, and suddenly post-COVID everything took a hit, so my entire audit plan would have gone for a complete toss. So that's where, as and when I get more info about the entity, the nature, the operating environment, I will need to be making a lot of changes in my plan. Currently, you need to be just agile, you need to be swift, you need to be flexible, you need to modify it. So horses for courses, again, the institute had come with a detailed guideline on how do you operate and work from home. So maybe now we are in a different situation, but when a lot of branch audits were being done somewhere in the month of May, or maybe in the month of April, especially during lockdown, when you were operating from home, where a lot of physical data was not being verified, then a lot of alterations and adjustments had to be made to the manner in which you perform the audit. The institute had given a specific guidance on that. So you need to follow those guidances and accordingly make adjustments to the plan based on the changing circumstances. Finally, you need to perform the audit effectively. That's the basic intention, and you need to certify, and that finally the true and fair view has to be held at all costs, and then the compliance with the standards of auditing which is there. So you need to ensure that the financial statements are free from material misstatements. There is no audit risk. When you're talking of an audit risk, it's more than the business risk which the business faces normally. It's again the misstatement risk that there would be an error or there could be a fraud in the financial statements. As an auditor, you would not be able to detect this fraud. So that's what you need to check, and that's what you may need to report. So updating the strategy and planning the nature, timing, and extent of how you would direct, how would you supervise, how would you review the work of all the team members, as well as Maybe if there is a review by a partner, so one partner, how does he review the work of another partner? So everything will be a part of the audit plan and strategy. Now, obviously, there are benefits of planning. So one is it needs to focus on key areas. So it's basically prioritization. So based on your risk assessment, which we'll again cover in SA 315, based on areas which are at a higher risk, maybe you'll place your attention or seniority of resources or timing on these areas. Now, if you have planned something and you know you need to attack maybe the low-hanging fruits first, either way as a part of your strategy, or you take the key area first, then it will help to timely identify and resolve the problems or potential problems which they are. Again, based on the planning, it will help you in assisting or getting the team members with the right capability and competency, so you can do your audit much better, and it obviously would facilitate direction and supervising of the audit team much better. So planning would have a lot of advantages. I think it's a thing well begun is half done. So if you have planned it properly, I think the timing, the nature, the extent, and the structure in which you complete, you don't miss out anything, you don't miss out on key points, you complete it on time, is all what you could have when you do it. So again, the audit plan would vary from entity to entity. If you are doing an audit for the first time, obviously the planning could be more in detail because you don't know what is in store. There could be various hidden surprises. Obviously, by experience, if you're doing an audit for a second time, the comfort level is higher. But if you're doing it first time, obviously you'll need to plan. Your professional skepticism would also be high. Your checking would also be much more detailed. So the planning will also need to incorporate a lot of these aspects. Now, in smaller entities, again, there would be cases where there may not be presence of controls. There might be a lot of overrides. There might be a lot of single person promoter taking control of a lot of things. So a lot of checks and balances in place in maybe other organizations may not be there. So in that case, you'll need to see and actually do a different kind of check around. So if a single person again is conducting the audit, let's say he's a proprietor, he's doing the audit, and maybe he may not have all the capabilities, then obviously the guidance note has very specifically stated that you take the help of experts, you consult experts at various stages. And I think that's the best way in which one should go ahead. So planning, again, your standard very clearly states what details you should have in the plan. So one is a terms of engagement, one is identification of significant audit areas, the analytical procedures to be done, understanding the legal and regulatory framework, the levels of materiality, the experts you would involve, the accounting policies which are there, what would you check, how you would check, when would you check. So the basic what, when, how, why the questions would be answered, how would you perform risk assessment procedures, what would be the nature and timings of the reports you would generate or reports you would issue. So all these would form a part of the plan. So these are some indicators or some pointers which we are given, but good checklist to benchmark. So that's what I said. Each entity would obviously have a different plan. Each auditor would have a different plan, but this is a general guideline or a yardstick which is given. So as far as possible, ensure that when you make a plan, this checklist of you and incorporate all those details. So the standard clearly requires us to document three things. One is document the overall audit strategy, document the audit plan, and what are the significant changes to the overall audit strategy during the audit period, and if it's changed, then what are the reasons for the changes. I think these three things are something which is mandatory, which needs to be there. Now please just introspect and just check in the latest audit if you have done, if there is a clear documentation. Okay, this is an audit strategy. So if I am a peer reviewer and I come and check your books, I would say before I starting anything, just show me if this is the audit you have, just show me where's the documented audit strategy. Show me a documented audit plan. And if there is any change in the audit strategy, or if there is no change, is there a document which says, no, during the course of audit, we didn't come across any circumstances which needed a change in the audit plan or a change in audit strategy. So maybe a nil documentation or whatever. So where is the documentation? ideally, yes, you could in consonance with the letter of the law, you could prepare any documentation. But I think once one goes with the flow, it's very easy, and actually one needs to do it because that will leave a structure for the audit. So just food for thought. Please introspect whether you have these 3 things in place to ensure compliance with SA 300. Now, the other points which are stated, I won't go much into depth, but they say that you consider if they're starting with an initial audit engagement, as I said, compliance with SA 220, and what you can include finally which you document is initially when you start any major issues which are discussed with the management, any audit procedures which you need to obtain sufficient appropriate audit evidence, especially regarding opening balances. And maybe you may have an internal system of quality control. You have your SQC1 in compliance with that. If you're doing anything extra, then all needs to be a part of this essay. Now, if this is a part of the essay, then please ensure that when you document this is a part of the documentation. So essay 300, like it has also some appendix. So specific consideration it requires you to consider. One is what are the engagement characteristics, what are the reporting objectives, what are the significant factors which are needed, the knowledge which is gained from other audit engagements, all has to be captured. And finally, the purpose is to plan the nature, timing, and extent of resources which you will need to conduct the audit. So based on ideally your perspective or your ideology or your thinking on need to do to ensure you give a true and fair view, there is no audit risk. You need to plan the audit risk. Suddenly it should not come as a surprise to you midway during the audit that you made a total error of judgment and you need actually more people, or you need people with much more seniority than what you're actually doing. And at the last minute, if there are deadlines, then you may not be actually getting those people in at that time. Especially during COVID, there were a lot of issues in getting the requisite staff. So here exactly there could be issues. So one needs to plan properly, not just the quantity of resources, but the quality of resources also, so that we would do true justice and do an effective and efficient audit. So that's it for SA 300. Overall, when I would like to sum up is just document the audit plan, the audit strategy, and the changes which are made to the audit strategy or the audit plan during this period. Just ensure this is done. So that's SA 300 for you. We'll quickly then move to SA 320, which is on materiality. After which I'll take the 2 standards on risk, the SA 315 and SA 330. So SA 320 talks with materiality. So like all other standards, this again has an introduction which talks of the scope and the effective date. In this case, it's from 1st April 2010. Again, it states an objective, it has a definition, there are certain requirements. So, and there is application and other explanatory material which is given. So an essay will obviously have these 5 parts. So one, what's the scope? So it deals with the auditor's responsibility to apply the concept of materiality in planning and performing an audit. Again, this has reference to SA 450. SA 450 talks of evaluating the effect of materiality on identified misstatements in the audit and uncorrected misstatements in the financial statement. So one is, if there is a misstatement, whether that misstatement is material, and if that misstatement is not corrected, then what would be the impact of the uncorrected misstatement on the financial statements is a part which is covered in SA 450. But what is materiality as a concept, as a generic, as I said, SA 450 would be actually the field work which is to be done. SA 320 is the general standard which will actually tell you what materiality is all about. So the objective is all about applying the concept of materiality appropriately in planning and performing an audit engagement. So one, when you're determining and plan also, when you're talking of a plan in SA 300, you will have to take care that you are doing and work, or you're performing or checking those areas which are material. So materiality will have to be factored in. So that's how you are linking SA 300 and 320 also. So Again, materiality is clearly defined by this standard. What is materiality? It defines materiality in terms of amount or in terms of amounts. It determines materiality in terms of either a single transaction or an aggregate of uncorrected or undetected misstatements as a whole. And the purpose of this is to reduce the risk to an acceptable level. So if it's something as material, whether as a whole taken together, it would be a misstatement which would maybe impact somebody's decision making, or it would lead to some wrong judgment being taken by the user of the financial statement. So again, materiality is applicable for either a transaction or a class of transaction, or materiality also applies to disclosures. So it's not just to amounts as far as a treatment in the books of accounts are concerned. So let's say that there is an impairment, and the impairment is in a few thousands of a company which the profits are in crores. So it may really not be material amount. Again, there's a small disclosure where there is some change in estimates, and the impact of this is in a few thousands and not going to make a big difference to a company like maybe of the size of a Reliance or a TCS, then obviously it's not material. So materiality again would vary from company to company, and it's a subjective concept. So it's the matter of auditors' professional judgment to determine what's materiality, and this essay actually gives on how you determine materiality. So the requirements are, its materiality is a judgment which is made in the light of all the surrounding circumstances, is based on the size and nature of the misstatement. It's based on the needs of users of common financial information of users as a group. So specifically, somebody has a specific requirement, the materiality concept may not apply. So it has to be with specific requirements of stakeholders. So regulator may be one stakeholder, the promoters may be one stakeholder, your shareholders may be one stakeholder, your creditors may be one stakeholder. So there'll be various stakeholders who would be reading the financial information and making judgments. So materiality has to consider the common reporting requirement or the financial information of a group as a whole, not for somebody specific who would be having one specific query or such. So as far as the requirement of specific users are concerned, the essay is very clear that materiality need not be used to for somebody specific may have something which may be material, but generically it may not be material. You need not consider it, and it's a matter of professional judgment. And at various points of time, there are assumptions which may be needed to base the materiality level on. What this standard says is, whatever are the factors on which you have based your materiality, please document it. So if your materiality level is a percentage, is an amount, is whatever, I think it needs, the standard clearly requires us to document it. So one is, while making a materiality level, there are certain levels of assumptions which the standard has stated that the person who is making the assumption has those attributes. So one is, it's assumed that somebody who's making a materiality level assumption has a reasonable knowledge of business, or somebody who's a reader of the financial information has a reasonable knowledge of business, is willing to study information, and he's understanding that the financial statements are prepared, presented, and audited to confirm two levels of materiality, and he recognizes there are uncertainties inherent in the presentation of accounts with reference to estimate, judgments, and in consideration of future events, and that reasonable economic decisions based on the basis of information which is used in the financial statements. So these economic decisions which are being made are being reasonable. So these are the factors which need to be considered when you make assumptions about materiality. And as and when the audit progresses, the materiality levels may change. Now they may change based upon receipt of more information. It's basically based on the nature, timing, and extent of audit procedures that you perform. You might get more information and you might need to revise the materiality figures. Again, as and when you go, you might find the materiality levels which you have considered earlier may be appropriate, or the materiality levels need to be revised upwards, or that you have considered a too low a materiality figure, and there would be a lot of transactions which would be falling in that, and it's really not worth going so much depth because the controls would be relatively very strong. So the materiality levels, even in respect to the extent of your checking, what you would do, the sampling you would do, would change then, and then it might need a revision in all your estimates, but you need to document why you are keeping a higher materiality level or a lower materiality level from what you had considered earlier. So all of these needs to be documented. The key is documentation. Everything needs to be documented. Now, what is it that we consider materiality for? And why are we doing all this? Because finally, when we are doing an audit, there is something which we call, or which is inherent, is an audit risk. Now, audit risk is a function both of material misstatement, and it's a function of we not being able to detect the misstatement. So what do we have to do is obtain reasonable audit evidence. Now, Srinivas sir talked a lot about audit evidence also in his day. So SE 540 will deal with audit evidence. So you obtain reasonable audit evidence which reduces the audit risk to an acceptable low level. Now that low level is the materiality threshold. In risk, there are other terms which an organization also uses. It's a risk appetite, which is a risk at a very broad level, at a gross level of risk. And then you have a risk tolerance, which is the risk at the residual level. So you have a risk, you have a control, then you have a gap, vulnerability, or threat. That which is at the residual level is the risk tolerance. So you have concept at an organization, enterprise risk management level of risk tolerance and a risk appetite. In an audit, you will have the concept of that you are reducing the audit risk to an acceptable low level. So one is you will have to identify and assess the risk of material misstatement. That's what your SA 315 also talks about. But when you're framing materiality, the materiality levels are a level which will enable you to identify and assess the risk of a material misstatement. Then you determine what would be the nature, timing, and extent of the audit procedures or the audit checks which you need to do to identify and assess this risk. And then if you have assessed this risk, what would be the effect of this material misstatements on the financial statements and informing an opinion on the auditor's report. So then your SA 700 series will all take over. And what is the nature, timing, extent of further audit procedures to be done? How do you identify and assess the risk of material misstatements? The identification stage is determined by SA 315. Your response to the assessed risk is determined by SA 330. So all the standards of auditing are interlinked. And as you go from one standard, you will have linkages to a lot of other standards. So all of these standards have to be viewed holistically. You can't look at one standard in isolation when you look at it. So what are the various benchmarks which are to be used in determining materiality levels? Now this is specifically stated in the standard itself. So when you are using a materiality, it has to be either single or a combination of all this. So you could have a profit before tax. You could have a revenue as a materiality level. You could have gross profit as a materiality level. You would have expenses, total expenses as a materiality level, the equity as a materiality level, levels with reference to a net asset value. You need to consider the volatility of all these benchmarks. So how volatile these benchmarks are. You'll also have to consider what is the industry in which you are looking at, what is the nature of the industry, what is the environment in which the industry is operating. So all of these needs to be seen. You need to compare prior period figures also to make a call on materiality. Percentages could be used, deviations could be used as materiality. The law, rules, and regulations need all also there. So there are certain laws where specifically they need to, when they check minimum percentage of transactions, whether they are being checked. So at certain points of time, your RBI regulations would check that require you to make 100% check of certain transactions. And LFAR of a bank audit would say a 10% test check of certain items. They also require you to report on all advances more than 2 crores or 5% of the total advances of the bank, whichever is higher or lower, whatever it is. So the laws, rules, and regulations will also determine the extent of your checks and maybe determine a materiality threshold. So each materiality threshold may change from industry to industry. It may change with comparison to prior periods also. And again, it would also depend on the expectations of the management and those charged with governance. So what I note as a key point here is please take it as an audit procedure when you are discussing with the management and those charged with governance. Ask them about their expectations of materiality. What do they think should be the materiality levels which an auditor should follow? Not that they can dictate and tell you what is sacrosanct, but yes, that would give you an idea of what's their expectation also. So that can have a bearing on what you could also decide. So that may not be the final word, but all the discussions which are held with management needs to be documented, and that again is one discussion on materiality. So one thing, again, food for thought, just go back and revisit your audits, and have you discussed the materiality levels with management, and have you documented this, and have you had this as a benchmark? I would not see a lot of practicing auditors do that. If I directly apply theory to practice, I would definitely not see as done. And in whatever limited peer reviews which I have done, I've seriously not seen this. So again, the documentation as to what is materiality, how this materiality has been arrived at, and whether during course of the audit, whether this materiality has been changed is what you would need to document. So with that, we've completed two series. If I'm going a bit fast, please let me know, because I would like to focus on the last two standards a bit more in depth. At this stage, at this point of time, having finished two of these standards, any questions I would like to take? So any questions in the chat which are there? Or shall I go with SA 315? Any feedback? Hello, any feedback? Shall I start with SA 315? So I'll take SA 315. SA 315 is on identifying and assessing the risk of material misstatement through understanding the entity and its environment. Now, it clearly talks of risk. And like any essay, this essay has the usual 6 parts. One is the introduction, the scope, the effective date, the objectives, certain key terminologies which are used and very, what you could say, critical to the understanding of the SA 315 are stated. The definitions we clearly need to know. And the risk assessment procedures we need to perform, the related activities we need to do. How do we understand the entity, the environment, the internal controls of the entity? How do we actually identify and assess the risks of a material misstatement? And finally, what do we document? And then it states your other explanatory material and the appendix. So one, it clearly talks of that the auditor is responsible to identify and assess the risk of material misstatement in a financial statement. And that's through understanding of the entity, the environment, and its internal control. So one is you understand the entity, the environment, its internal controls. You identify and assess the risk of material misstatements, whether due to fraud or error. This could be at the financial statement level or the individual assertion level. And based on this, you design and implement your responses to that assessed risk. And the ultimate objective is to reduce the risk to an acceptable low level. So that's the objective in crux in terms of flow chart. Now it has 5 important definitions. One is an assertion. What is an assertion? An assertion is nothing but a management representation which is embedded in the financial statements. It could be by way of notes also. And it is used to assess potential misstatements. Now, the second key definition is a business risk. So all businesses face risk. Now, one is, what is risk? Risk is anything which can go wrong. Risk is anything which we don't see coming. Risk is anything which doesn't go as per plan. And risk is something which causes us a loss or it has a negative impact. So though a risk has an upside also if it's managed well, I think we all look at risk as a part of a threat, a vulnerability, or a gap, or a downside, or a loss finally. So it causes a financial loss. It could be as a result of any conditions, it could be as a result of any event. So COVID was an event, so which caused quite a huge loss. So one is a pandemic is a black swan business risk, but these risks are becoming very common. So one is an event, our actions or inactions. We may have taken certain actions which may have been wrong. So going out without wearing a mask in the height of lockdown, or breaking the lockdown rules or the containment rules, may have been one action which could have caused further losses in terms of maybe infections of key resources who would have been there, or maybe the inaction of it. So we've acted wrongly, or we have not acted what we were supposed to do, maybe having a social distance or having sanitizations or hygiene, whatever. If you have acted or not acted, maybe the circumstances, yes. Inappropriate goal setting can cause a business risk. And whatever it is, it adversely affects the achievements of your goals and strategies. So that's business risk. I'll again go to my screen share once again. I think some issues. Till the time I go to the screen share, yeah, so just a minute, just these are inevitable risks which you have. Yeah. So the third definition, which is there is the definition of internal control. So what are internal controls are defined very clearly in this standard. So these are processes to ensure reliability of financial reporting, effectiveness and efficiency of operations, safeguarding assets, and compliance with applicable laws and regulations. Now, one thing which an auditor specifically needs to ask a basic question, and this is what should also come in his plan, is does the organization have a sound system of internal control? So every risk is a control. Every risk has a control, and risks minus controls are nothing but your gaps, threats, and vulnerabilities, which finally the risk of material misstatement is what a statutory auditor ideally has to address. So what are the controls which ensures reliability of financial reporting? What are the controls in place which ensures effectiveness and efficiency of operations? What are the controls in place for safeguarding of assets? What are the controls which ensure compliance with applicable laws and regulations? Now, one is, are there documented controls? So if an organization does not have documented controls, technically the auditor will have to report or document that there is no structured framework of internal controls in place to address risks. And when he has noted these findings, the nature, timing, and extent of his auditor procedures which he is doing will increase. So again, another food for thought, just introspect. Whenever you have done an audit, have you noted down and specifically asked the management, do you have documented internal controls in place? Give us those documented internal controls. If those controls are there, are they forming a part of your audit working file? If they are not there, then have you documented your assessment of risks accordingly in a manner that the organization which you are auditing doesn't have a documented internal control in place which ensures these 4 things which is specifically required by SA 315, and accordingly have you increased the nature, timing and extent of your audit procedures because there are no formal controls in place to formally address the risks. Now the question here is, this is control, but when I'm going back again to the business risk, has the organization documented its risk? So the basic question you would address is, does the organization have a formal risk register or a risk universe or a risk library as we call it? So one, if it doesn't have, second, it doesn't have a documented internal control specifically mapped to the risks, then you'll have to document it in your SA 315 documentation, which is required, which I'll just go when we come to the end of the documentation part of this essay. So if this is not there, the timing, nature and extent of procedures will increase, and has this documented. So ideally, this would be the first thing which a peer reviewer who's checking a SA 315 part will come and ask. And this is what one needs to do, needs to document these 2 stuffs. Again, then what are the risk assessment procedures? The RAP is the short form, what is called as. What are the risk assessment procedures you have done to understand the entity and its environment, and identify and assess the risk of material misstatement, whether of fraud and an error, either at the financial statement or an assertion level. And if there are significant risks, have you defined what is a significant risk and any significant risk which requires a special audit consideration? So all these are clear definitions in this standard, and this is what would require documentation as a part maybe of your overall audit strategy. Also, the audit strategy should be one that it should be able to identify significant risks and frame your responses to those risks in terms of both SA 315 and 330. So has this been identified? It's a part of your plan, it's a part of your strategy, and has this been done? So that's what you would need to consider. Now, why RAP? So one is, it gives a frame of reference to assess the risk of material misstatement. Again, a linkage to the relevance of materiality, the selection of appropriate accounting policies, again, the application of those policies, the disclosure of the policies, identify areas which need special audit consideration, analytical procedures which are used, again, that's a separate standards of auditing which is there. Now, once you have assessed the risks, what is your response to those assessed risks of material misstatement? And what, again, Srinivas had used is the sufficiency and appropriateness of audit evidence. So when there is a risk, you need to de-risk. You will need to see whether there is a sufficient control in place. And for the design or the operating effectiveness of that control, you will need evidence. You will need sufficient and appropriate audit evidence. And you will need to document how you have checked. So what you have checked, how you have checked, to what extent you have checked, when you have checked. I think this should be all a part of your work papers which should be documented that you have done this audit with reasonable due care and there's been no negligence as part of your performance of duties is concerned, so that you reduce the risk to an acceptable low level. So have this all in frame of mind. Please have a look at it. I think a lot of us do it very generically. We plan what we think, we plan out of logics, but at certain points of time, these essays are giving us structured checklists of structured requirements. So please note this and please incorporate that in your audit procedure. So it talks of 4 specific audit procedures. One is inquiries of and from management, your observations and inspections, your inquiries from others, maybe it could be from external resources, from vendors, or surprise checks from anybody outside the system, analytical procedures. So these are the 4 types of RAPs which are recommended by the standard. So what have you done? If you have made inquiries from management, when have you done it? With whom have you done it? What have you asked? What were the responses that you have got? What is your assessment from the response? Have you been satisfied or not? And has this been documented? So the key is documentation. I think somewhere that's where SA 230 generically is a standard, is a Bible in itself, where we need to document. But a lot of these standards will tell us actually what we need to document, how we need to perform the audit. So this is something we are doing day in and day out. We are inquiring, we are observing, we are inspecting, we are observing and making inquiries, not just from the management, from a lot of other sources. We're conducting a lot of analytical procedures, but what we really do is we just do it as a flow. It's a natural state. It's something as an auditor, we just like one, when somebody is driving a car at 10 years of 15 years down the line, he at times can he just drives with the flow. He just doesn't need to remember this. I need to change my gears. Now with the auto gears in place, one doesn't even need to have a system of a clutch to change the gears. So that's where one just goes with the flow. But here you need to also understand that you would need to document all this, because that's specifically required as per this essay. And adherence to the essay is mandatory, both as a part of 143.9 and as per the requirements of the institute also. And non-compliance with these essays would be a deviation, and it would also ensure disciplinary action. So again, that's again something which one needs to know. Then whom would you make inquiries from? One, from those charged with governance, from internal auditors, for employees, from your marketing personnel, from your in-house legal counsel. Again, the standard has given the source as also what you could get the information from. So when you actually document it, you have discussed this, what you need to discuss with those charged with governance is clearly stated. So the standard, actually, if you look at it and read it, it actually tells you how to actually conduct an audit. So even for a fresh chartered accountant or a beginner, or from anybody, any senior, it just gives you a structured flow how to do it. And if you really follow the standard, I think the levels of efficiency and effectiveness by which we conduct an audit would just compound maybe a 3x, 4x times. I really don't know. Maybe structuredly following the audit, when I've done it and what I used to do in an unstructured way, maybe it used to take me a bit more time, but the results and some of the findings which I used to get were clearly much deeper, and I got to be aware of a lot more things. So one is, this will help you to identify those aspects which an auditor was unaware before. Obviously, when you give a structure to anything, you will have a lot of information, and you will have a lot of insights coming in. So what if you need to, once you get it, how would you design and implement your response to those assistance? There'll be a structure. So unusual transactions, unusual relationship which we give rise to a nature of fraud. I think once you have a structured risk analytics procedures, you will unearth it in a much better way. And one is, it would also, the observations, inspections will support and collaborate in the inquiries which you've done. It will give more information about the operations, the documentation. It will give more information about the management, those charged with governance, the premises, the plants. Again, the standard very clearly says that in a smaller entity, a lot of these things are done by a sole practitioner. Again, when it's a sole practitioner, he will be solely responsible to consider financial statement susceptibility to fraud and error. And in such cases, it's better to consult other experts and experienced auditor wherever it's possible and felt necessary. So wherever there is any issue, or wherever there is any expertise which is not there, an experience which needs to be also put in, and maybe in a sole practitioner who's not doing it, the standard very clearly says that he should take help of experts, a clear discussion, documented discussion with any senior chartered accountant or any part of the management group or peer group, you could do, and you could document it. So again, it's very clearly given as what is the entity and its environment, the financial performance, the accounting policies, the objectives of the entity, the nature of the entity. So it's very clearly talks about the governance, the ownership, the structure, the financing, the investments, the operations, the review and performance, the selection and application, the appropriateness and consistency of policies and accounting policies vis-a-vis the financial reporting framework, related business risks which may lead to a material misstatement. So this is how you understand an entity and its environment, and this is how you document it. Now again, don't want to scare you. It's not that you need to do a very comprehensive 100-pager assessment of that entity and its environment. But yes, basically, when you are framing your understanding of the risk, you need to consider this and broadly note this when you are assessing what could be the risks. So again, what are the industry factors? What are the regulatory factors? What are the other external factors are all a part of this SA 315, which is quite a detailed essay. So how do you understand, what do you understand? So the business operations, what are the sources in which you generate revenue? How are operations conducted? What are the various stages of production? Are there any JVs? Are there any outsourcing? What are the geographical locations in which the entity operates? Who are the key customers and suppliers? Are there any R&D activities? Are there any related party transactions which are linked? All of these need to be considered before we consider the misstatements or the risk of misstatement. So this is how you analyze and go in depth. The standard talks of a lot of these. So have these as a checklist point and quickly fill it up and then frame your understanding. So investment activities, the financing activities which is done, the financial reporting in terms of accounting principles, which this entity is adopting vis-a-vis the practices which are carried out by the industry. How is revenue recognition done? How is, if it's a fair value accounting, how it is done? If there are foreign exchange transactions, then how are they being accounted? How would you assess the risk of a conversion or a hedging if it's there? And if there are any unusual complex transactions, then how are that being considered? So all these factors need to be seen and they need to be documented to identify and assess the risk of a material misstatement. So that's the depth of the standard, that's the depth of the documentation you need to do, that's the depth of the background work of the planning and strategy you need to do before somebody is actually conducting an audit, and it's with benchmark to that this audit is being conducted. So that needs to be seen. So again, significant unusual transactions, again, effect of accounting policies in controversial emerging areas, the changes in accounting policies is any, if there are any changes in standards, laws or regulations which are applicable to the entity, how you would look at it. Then again, what are the strategies, what is the approach, what is the understanding of business risk, what is the management responsibility, how does the management does that. So all of these needs to be factored in. So he needs to consider industry development, whether there are new product services, whether there is a business expansion, whether there are new accounting requirements which are there, if there are any regulatory requirements, the current and prospective financing requirement, how is IT used, what are changes in IT which is being happening. Just today you saw a headline of HDFC Bank being facing some IT snags, and the regulator has called for a freeze of IT being used for the next some new products being rolled out, and maybe that there's another headlines in time which say that could last for about 3 or 6 months. So again, a classic example of risks, an IT risk. This is an operational IT risk which somehow maybe with technology being there and used so abundantly, there could be a process when IT would fail, and that's where you need to factor a lot of these things. And how do you implement the strategy, or how is the strategy being implemented? Is it effective? Is what you will need to consider. So overall, the entity, the measurement, how would you review it? What are the key performance indicators? If there is a budget, there are forecasts, there is a variance analysis. If you're performing employee performance measures, are there any? Are you comparing it with competitors? How do you actually compare it? If there are external parties who are evaluating the analysis which is done, yes. Now, I think one of the biggest statements which is being made is targets. Setting of targets is what leads to mis-selling, and which may motivate your management to misstate the financial statement. So there is an pressure to surpass competition, or pressure to show good results or better results. That may lead to some wrong accounting practices being done, that may lead to misrepresentation. And that's what the auditor needs to be really careful of. So one needs to obtain an understanding of the internal controls. In a smaller entity, the controls may not be in place. The auditor will need to factor that, because there are limitations of controls. There can be a collision of these controls. So maker checker is one control.
but maker-checker can by collusion be overridden. There, there is a management override of controls which can happen. That's why you have those job rotations, you have reconciliations, you have authorizations, you have balance confirmations, you have independent reviews, you have a wide variety of control, physical verifications, you have inspections, you have a lot of external, internal matchings which is done. So that's where controls are there. So any risk will obviously be there. There are controls in place. Controls can be manual, controls can be detective, controls can be proactive, controls can be reactive, controls can be collaborative, controls can be deterrent. So there could be n number of controls in place. Controls also have a cost, and it's because of the cost that the management at times may be penny wise pound foolish and not implement a lot of controls, because obviously they would have limitations of cost as well as limitations of resources. With technology, yes, and with continuous control monitoring of certain areas, or with robotic process automation, a lot of repeat issues can be checked more effectively and efficiently, and that's where controls are being strengthened and improved as and when it's happened. So are then the controls, if there's something which you have no controls in place, then have you actually ensured that, or have you actually hedged that? So, or if you don't have expertise in a particular area, then have you actually outsourced that work? So there'll be a lot of such controls in place, and risks will have to be evaluated with reference to those controls. And post those controls also, there are some gaps, there are threats, there are vulnerabilities. That's where on the residual risk, the auditor will have to take a call on what would there be chances of a material misstatement which would throw his financial statement out of gear, and that's where he will have to give his responses accordingly. So you have automated control, there are benefits, there are risks also. There are cases where manual controls are suitable, there are countries with where automated controls may be more suitable. Then you need to consider materiality, you need to consider the size of the entity, the business of the entity, the diversity and complexity of the operations of the business. What are the internal controls? How are they applicable under changing circumstances? Understand how a specific control would either prevent, detect, or correct a misstatement. So the nature and complexity of the systems in operation, the legal regulatory requirements which are there in force. So all of these would be relevant to understand the controls. So once you understand controls, then how do you comply with procedures to, so maybe making inquiries or observing or inspecting or tracing a transaction end to end. So that's the procedures which you will need to carry. So you will need to understand the control environment, the COSO framework which is there, the control activities which are in place, the risk assessment procedures which the entity is doing, and the auditor will also will conduct his risk assessment procedures to ensure that whatever would be the risk of misstatements would be at an acceptable low level, the information systems which are in place, the monitoring of all these things which is happening. So all of these will be a part of control environment, and what would be the elements of this? So you will have HR, you will have those charged with governance, you will have a commitment to competency, you will have a management philosophy and an operation style, you'll have a structure in place. So is there a structure in place? So the structure itself will give you a maker checker. So any of these parts not being there will itself increase the risk and will increase the response to assessed risk. So SA 315 is a very exhaustive standard and which gives a lot of stuff which is there, and again food for thought. Just go and have a look at this standard, or maybe this presentation if it's made available to you by your branch, and just benchmark your planning, your strategy, or your SA 315 checklist tick box, or the planning or the performance of SA 315 you do to ensure that you are on top of this. So again, what is the risk? Estimate the significant risk. What is the likelihood and occurrence of this happening, and what is the response? So risk is a function of probability and the impact. The probability that it can happen, and if it happens, what would be the impact which it cause. So once you note that risk, you've evaluated the risk, you have prioritized the risk, then what is the action you are taking to mitigate the impact of the risk? And that's where your response will come in. So again, you'll need to have a proper information system. One is to identify and record valid transactions, appropriately measure the value of transactions. You'll have to proper present and disclose. You'll have to have a detailed description of transactions and a proper classification of those transactions. You'll have to determine proper time periods within which the transactions will have to be recorded in the proper accounting period. So you'll have to have a relevant account information system for that. And have you tested this information system? All part of SA 315 is what you should do. So SA 315 is a very exhaustive document in which will give you what needs to be done. So what are the control activities you need to do regarding segregation of duties, regarding physical controls, physical verifications you need to do, some of the performance reviews, the testing you would need to do, the actual flow of information as it processes through the system. And again, a lot of IT controls, the general IT controls, the change control, the access controls, the application controls, all would be a part of what you need to see again at the financial statement level, at the assertion level, one at the year end, one during the year. So one during the year, it's something about the occurrence of the transaction, the completeness of the transaction, the accuracy of the transaction, the cutoff procedures, the classification, and at the year end of the existence of the asset, the rights and obligations which is created to put your assets and liabilities in place, the completeness, the valuation, the allocation, and then the presentation and disclosure. So it will all be risks which one needs to see and to ensure that these have been identified properly. Again, there will be various non-routine transactions, unusual because of the size and nature and because they don't occur frequently, and that would entail a matter of a separate audit judgment. So again, as and when you would come across further information, your risks may keep on changing, your assessment of risk may keep on changing as and when you get new information. So your audit planning or your audit procedures which you're conducting may need to change. Your risk assessment which you had framed initially will need to be revised. You might need to obtain further audit evidence as the audit evidence may be inconsistent, or you may obtain further audit evidence which may be inconsistent with what you have obtained earlier. So that may entail a change of risk assessment. So the standard requires you to document that also. So finally, 5 things to just wrap it up. What this will need is discussion with the engagement team and the significant discussions reached. The key elements of understanding of the entity, its environment, and the internal control. Have you identified and assessed the risks of material misstatement at financial and assertion level? Risks that require special audit consideration, and risk for which substantive audit procedures alone will not suffice and you will need to do some extra test checks and balances. So this is a clear-cut documentation which is expected of SA 315. Please again revisit your audit procedures, and if something else extra needs to be done, please have it in your audit planning or an audit strategy or your documentation requirement, so that you are on top of this. So this we've completed SA 315. We'll quickly move to SA 330 and just wrap it up. Any questions you can ask me quickly. Again, SA 330 is the response to assessed risk. We covered it quite in bit in SA 315. So again, this standard will again have the usual 5 parts: the introduction, objective, definition, requirement, and application. And it talks of your response to assessed risk. The objective is to obtain sufficient and appropriate audit evidence on the assessed risk of material misstatements. And one needs to design and implement appropriate responses to risk. So this is, you have identified a risk. Now you design and implement a control to mitigate the risk. So that's what SA 315 talks of risks. SA 330 is a lot more about controls. We discussed that in SA 315. I discussed that in depth also, and I'll quickly go through that. So this is all about responses. Now it talks of 2 things. One is substantive tests. So it talks of test of details, test of classes of transaction, test of account balances, test of disclosures, test of analytical procedures, and substantive procedures are the audit procedures which are designed to detect material misstatement as an assertion level, what you assert, what you state. And test of controls will be the audit procedures for evaluating operating effectiveness of controls in preventing, detecting, and correcting material misstatements at an assertion. So this is the test what you need to do. Now, these are responses which are there, which one needs to, you have to have an emphasis on professional skepticism. You need to assign more experienced or skilled staff. You need to maybe supervise more. You might need to incorporate some amount of surprises or unpredictability in your audit procedures. Maybe you need to change your nature, timing, and extent of audit procedures that you do. So that you may need to see. You need to also check whether there are any weaknesses in the controls, whether the controls are not there at all. So one is there is no design, and one, even if it's a design, it's a weak operation. So then you might need to control more audit procedures. So something like you have an accountant, but that accountant is not a chartered accountant, just a fresher. Obviously, he'll be committing a lot of mistakes. Or somebody who's there, who's a chartered accountant, but he's a fresher, he doesn't have an experience of that industry. Then the chances of the errors which he would commit would be higher. So you would need to conduct more and detailed checking. Again, maybe the circumstances would have been changed, there would have been a takeover, or there would have been, you may be doing things for the first time. A lot of the number of locations would have increased. There could be a lot of things which would be there. You just need to see the circumstances, see what the risks are, see what the controls are in operations. Again, in a smaller entity, as you said, the controls may not be there. The documentation would be limited. You need to do much more activities. Then again, what is a significant risk? And controls over significant risk should be specifically tested in the current period. So that's the specific requirement of the standard. So have you assessed first what is the risk? Within the risk, what is a significant risk, and have you factored that in? And then you need to evaluate also the adequacy of presentation and disclosure, whether in the overall presentation of financial statements, the disclosure is as per the financial reporting framework. So if it's an Ind AS which is applicable, are your disclosures in response to the Ind AS? So that's the sufficiency and appropriateness of audit evidence which you will need to do to assess whether the controls are designed and in place properly. So one needs to do that. One, he cannot assume that an instance of fraud or error is an isolated occurrence. So if there is a fraud or error, then the auditor will have to go in depth and ensure that this is not a solitary case. And sufficiency and appropriateness is the key. Again, it's subjective. It's a matter of professional judgment. The higher the skepticism, in COVID times, the direction of the institute was very clear that you increase your level of professional skepticism. So in such cases, the audit evidence which you would need to consider would be higher. So one is, if you're not able to obtain sufficient and appropriate audit evidence, then you clearly either you qualify, you give an adverse opinion, or you give a disclaimer. In either way, then your 700 series takes over. So that's what you will need to do. And then what do you document? Again, the key, the crux of the standard is, yes, you may learn a lot of things, they may tell you a lot of things, but finally the documentation, again, the form, the extent of documentation is a matter of the professional judgment of the auditor. But what he needs to document is the overall responses to address assessed risks of material misstatement at financial statement level, and nature, timing, extent if further audit procedures are required. So first is he has to assess risks. He has to assess the controls in response to the assessed risk, and based on that, whether there are any gaps, threats, vulnerabilities, and whether based that he needs to increase his audit procedures from what he has overall laid out in his plan and strategy. And then he has to link all the procedures which he performs to the risks of assertion which are there. Then what are the audit procedures and the conclusions which he has reached, or where he is not clear, he has to document those results. And finally, he has to conclude on the operating effectiveness of controls tested also in the previous audit, and whether if he has relied on those controls and not tested it again, then why has he done it? Or ideally, he needs to even test it again in this year. So he may not test the entire controls, but he is very confident of certain controls. He will skip some controls, but again, that's a matter of his professional judgment, and that's a matter of his risk call also. And one is as a clear-cut demonstration that the financial statement agrees and tallies with the underlying accounting record. So that's the basic presumption. I think more so after the PMC scam, when the accounts itself, where there was a separate set of accounts which was coming out in the press as was being maintained. The original set of accounts, agreeing with the accounting records, is the basic thing which he should do, and he should document, and that's a clear-cut part of the SA 330. So whether you have tested any control which says that the financial statement agrees with the underlying accounting record, obviously all of us do it, but again, one food for thought: have we really documented that we have done it? And let's say XYZ of our article has done it, or XYZ of a chartered accountant has done it, so on what date he did it, how he did it, are there any work papers attached that this has been checked? Whether that's a part of documentation is what the standard says. So the standard doesn't say that you document for the sake of documentation, but documentation is for the sake first to actually conduct that check. And then having conducted that, just put it on record, because putting it on record and document it gives it a formal structure. And while documenting it, you might know that you might not have performed a certain procedure, and you may need to actually do it, and maybe the results could pleasantly shock you or surprise you. So that's what you need to do, and that's what is accounting standards of auditing all about. I think I've just come to the conclusion of I just reached a small part of my time, but 4 standards, quite a lot of things to say, quite a lot of things to report. Again, I don't think one can do full justice in the small time, a lot of information to disclose, but please remember to document the things which are specifically told to document, at least comply with the letter of the law to ensure that at least you benchmark or you do the audit more efficiently and effectively as is required. So once you start documenting by letter, the spirit will obviously come in. Ideally, you need to follow the spirit. We are all following the spirit. We are not following the letter in requirements to the documentation part. Let's follow it. So we would be much better than what we actually would be doing an audit, and we would also give a high benchmark or a high standard for others to emulate. Thank you. I think one thing which is coming, the more I keep on reading this, the more I speak about this, the more I learn how deep one needs to learn, and I come to know of my own ignorance also. So thank you, Nashik branch, for letting me also deep dive once again on this topic, and I would like to thank you much more for giving me this opportunity to once again revisit the standards of auditing in depth. Thank you.
Any questions?
I hope, Srinivas, I did justice to the topic.
Yes, definitely yes. There was one more question actually in the chat box. I don't know whether the person is still there. He was asking that he himself, there was a question already answered, but he said that if the report is given, a transfer pricing report, he himself has given, in which he has added some values, and said that this value is not right, then whether this is the event, subsequent event, which will affect accounts. In my opinion, no, because even if as an auditor you say a transfer pricing in the transfer pricing report that something needs to be added to the values, that is to the sales or to the rates, it may not be accepted by either of the parties. They can contest this also. So that is not a subsequent event by you yourself saying that a transfer pricing report that this is not right price and not comparable price. By itself, it will not change the accounts of the previous year, is the answer to that question. It was there in the chat box in the past.
I will just answer it from a different perspective. So if this is what is during the course of audit, the auditor has found out that certain figures need to be changed. So from a control perspective, he'll need to see why were this not identified, and the transactions were entered by the entity itself. And maybe that would need to determine the nature, timing, and extent of further deep diving. And maybe he may need to document somewhere as a part of his overall audit plan whether that needs to be increased, or maybe in terms of link this in terms of SA 315 and SA 330 also.
Yes.
As a part of pure theory, I'm saying.
That's right. Yeah. The organization may not accept that, is what I am saying. that
So I
this
think
addition.
Srinivas,
then
but I think it should all, I think thanks to you, because you got me involved, and the more I'm interacting with a lot of our professionals, the quality is beyond doubt. I think there is an impeccable high level of quality. What I've seen, my experience is that somewhere we need to strengthen our documentation part. I think that's where we need
That's
to,
right.
to
That's right. You're
emphasize
right.
on.
You're right. Yeah, quality is there, but we don't document. Everything is in the head.
Yes.
Everything is in the head and nothing in on the paper. That will create huge problem in disciplinary and other cases. And now NAFRA on our head. So that is very important
So
documentation.
can any IT guy just have a chip where when we are doing an audit, he fixes it in our head and he just links it with the standards of auditing, and he just puts it, because we've all thought of it in our mind, and he can document it as per the essay.
Yeah, we are trying to develop, as an institute, we are trying to develop some packages for audit, and probably if we can use them, then this documentation would be automatic. Let us try that. We are trying that. We have kept aside some 100 crores for this. Initially 30 crores, which can be increased to 100. So I think let us have we may have such kind of packages in the future.
Thank you.
Thank you. Thank you, Rohan, for inviting us, both of us. You can close this session.
Sir, actually, sir. Thanks to you. Thanks to you. First of all, let me thank Abhijit Sansgiri sir for accepting our invitation on behalf of Nashik branch. And thanks to Srinivas Joshi sir, always helpful for Nashik branch in conducting events. We had a wonderful session on auditing standards for 2 days with wonderful speakers. Once again, thank you, Srinivas Joshi sir. Rohan, sir.
Thank you.
Yes, thank you. Thanks a lot. Thank you all. Thank you, participants. Thank you, both of you.
सर थोडस लेट झाला सकाळी, एक्झाम सेंटरला गेलो होतो थोडस.
ओके.
हा, तिथे विजिट करायला रोज.
आय एग्री. नाही करायला लागतं, आणि ते झालं, ठीक चालले ना एक्झाम इज गोइंग ऑन वेल.
एकदम फंटास्टिक. 7 सेंटर्सला एकही प्रॉब्लेम नाही. फक्त थोडा कुरिअरचा थोडासा इश्यू झाला होता, कारण की ते स्पीड पोस्टनी ते फिजिकली चॅलेंज लोक आहेत, त्यांचा 1.5 तास एक्स्ट्रा द्यायला लागतो. स्पीड पोस्ट बंद होऊन जातं 6:30ला, त्यांना रिक्वेस्ट करायला लागते.
अच्छा, त्यासाठी. पण सब्जेक्ट टू दॅट इट इज
एकदम फाईन सगळं.